The market is just hoping that we've got the worst of the tariff story behind us.
The longer this goes on, the more uncertainty pervades, the less likely, the upside becomes a reality.
It's no longer uncertainty. It's not what we don't know, but unpredictability of how things behave or things react.
I just caution people, things may have to go down a little bit more before they go up.
Things can get a little bit sloppy over the next couple of quarters.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday as the president closes in on 100 days. President Trump heading to Michigan with some relief for Detroit, on track to lift some levies on foreign auto parts. The pressure to do more rising as a flurry of polls show increasing discontent with the U.S. economy, leaving Secretary Bessent doubling down on the tax effort.
What you can see is that as we go into the tax negotiations of the final stages of the tax bill, we're going to see the president's campaign promises: no tax on tips, no tax on Social Security, no tax on overtime.
It's an aggressive timeline. The Treasury Secretary aiming for Independence Day.
July 4th, they can get this tax bill through and possibly change the narrative. I think it's really important, as you said at the top, there has been a shift in sentiment. It is no surprise that President Trump has spent most of the 100 days at Mar-a-Lago, at the White House. Now he is getting out on the road, going to the Rust Belt with some promises of some exemptions or some relief for auto manufacturers. At the same time, they have to shift the scene, given some of the sequencing and how it's been received.
Francine Lacqua just caught up with the Goldman CEO. The Goldman CEO, Mr. Solomon, turning around and saying this is an unhealthy level of uncertainty. And this is what we're seeing from UPS right now, not providing any updates to previously issued year outlook.
This is becoming increasingly common. You're seeing outlooks withdrawn, ranges of outlooks given, or potentially no credence being given to any outlooks that they have. UPS is one of the incredible rush of earnings that we're getting this week. 44 companies themselves are going to be reporting. GM later this morning to be reporting earnings at a pivotal time. How do they give guidance given the whipsaw that we've seen in tariff policy?
UPS saying they'll provide an update to the outlook in the first quarter earnings call. Looking at the headlines in front of me at the moment from UPS, as Lisa talked about it, GM's going to drop a little bit later. But better music coming out of Washington, Annmarie. More lines on tariff relief, additional push on tax cuts. It can't come quickly enough.
And this is why the market is so uncertain, because the situation still remains fluid with the number of these tariffs. You have a 25% levy on autos, but now what the administration is talking about is there's supposed to be another levy on auto parts. So thinking of giving a reprieve. And also, if you're already paying a tariff on the autos, maybe then we're not going to double tax you, and then you have to pay a tariff on the aluminum or steel. This is why the situation is so tricky. It's two step forwards, Jonathan, at many times, one step back.
Equity futures this morning just about positive. A 5-day run of gains on the S&P 500. Positive here by 0.2%. Coming up on the program, we'll catch up with Brian Nick of NewEdge Wealth with stocks on a 5-day winning streak. Lee Klasko of Bloomberg Intelligence reacting to earnings from UPS. And Stephanie Roth of Wolfe Research on headwinds for the labour market. We begin this hour with stocks higher as the White House signals tariff relief for autos. Brian Nick of NewEdge Wealth writing, we are concerned this may be the eye of the hurricane as the tariffs are still in place and their real-world impact has yet to be felt. Brian joins us now for more. Brian, good morning. Good to see you.
Good to see you.
The first cracks in the data, are we seeing them already?
Yeah, we are. And we're seeing stocks being impacted in the areas where we're getting real-world data that's showing the impact of the tariffs. We're seeing fewer and fewer tankers, shippers coming from China to the U.S. We're seeing empty ports. We're seeing lower trucking volumes coming from the West Coast into the rest of the country. And the Dow Jones Trucking Index is the index that has not recovered at all from the Liberation Day swoon in the rest of the equity market. So the concern is less worried about uncertainty, more worried about certainty of reality being bad. And if the resolution of uncertainty is we're going to get these ripple effects through the economy, that's not good news.
Torsten Slock of Apollo's made the point that we'll see the drop-off in trade, trucking's next, retail layoffs come after that. Is that how you see this playing out? And what's the timeline for that sequence of things?
So the thing I'm going to be most interested in about the GDP report for the first quarter, even though it's very backward-looking, is inventories. And we want to see this about the earnings calls, too. What are the companies saying about inventories? Because how much restocking and sort of cautionary stocking there was in the first quarter is going to determine how long we can go, how long consumers can continue to go to stores, find things on the shelves. Is it going to be 1 month, 3 months, potentially longer, because there was such a huge buildup in inventories in the first quarter in anticipation of exactly what we're seeing. But we're not optimistic that we're going to be into June and July without starting to see some broader ripple effects in either the labor market or in consumer spending, especially if people see prices going up and decide they're going to pull back.
To build on that with the idea of inventories, how are you looking at some of these earnings that are hardly guides? I mean, basically, you've got UPS saying macroeconomic uncertainty is too difficult to really start to game out with any kind of projection. You've seen a whole host of different companies, including the airlines, withdraw guidance entirely. What do you do with that?
Yeah, and look at the Dallas Fed survey yesterday. The comments section of the Dallas Fed, these people were euphoric after the election, and now they're saying, we have no idea what to do. You're giving us nothing. It's just tariffs all the time. We don't know how to plan. I would say, in terms of the guidance we're seeing, one of the things we like right now actually is technology. They seem to be coming through with, not necessarily positive guidance, but at least relatively stable compared to the rest of the market. Earnings have beaten more in that sector than in others. But if you're looking at the economy as a whole, how can consumers plan for these higher prices? We're going to start to see them on online retailers. They're going to start to show the tariff impact. I think the hope here is that this becomes a political problem before it becomes a severe economic problem or an earnings problem. And people start to see specific items that are high salience, but maybe not impactful to GDP or to corporate earnings, but they just start to see things going wrong in their daily lives in terms of what they can buy. And that ends up being a bigger political problem, and we get some resolution here.
Right now, there seems to be a pretty big distortion developing in markets where you have the front end of the U.S. yield curve pricing in a pretty negative situation with respect to growth, even as inflation expectations on the margins creep up, at least in the near term. Risk assets haven't felt it. We're close to where they were on Liberation Day. So how do you reconcile that? What will make some sort of convergence or divergence, ongoing divergence between the two?
I mean, Jonathan said the hard data. I don't think we're going to get a bad report this Friday for April. I don't think that was soon enough to see a deterioration. But we get one or two of these big tier one hard data reports, whether it's retail sales, consumer spending, maybe May or June payrolls. If that starts to look negative, we'll start to see a capitulation, I think, in equity markets, knowing that this is going to be sort of a more severe cyclical downturn. And that will be consistent with the idea that the Fed's going to be cutting rates. I'm not sure, certainly not for next week and potentially not for June either. We're going to see enough bad news in the near term to get the Fed off the sidelines, maybe until July.
So when it comes to Washington, D.C. policy, we heard from the Treasury Secretary trying to move the conversation forward when it comes to taxes. Do you feel like then potentially you would become more bullish when you see the entire policy perspective?
You just need to know what the tax bill is going to have in it. If it's just a continuation of basically the rates that we've had in place with some other kind of sweeteners thrown in, potentially for short periods of time, because it's not clear how they're going to fit all this into the tax bill, especially if there's a reluctance to cut spending. And this is where the tariff issue feeds into the tax bill. If the tariff issue is causing political pain to people in Congress, people in the White House, it's going to be harder to get people to take tough votes on things like big spending cuts. And if you're not cutting spending, you can't cut taxes as much either without increasing the deficit a lot. There may not be the votes for that. So the things I get nervous about with the tax bill is there's too much optimism baked in, that these tax cuts are not going to be long-term enough because they can't actually find the money to extend them forever, let alone for 10 years. And also that by the time they're discussing this, July, August, and they're trying to pass this, we're going to be in more kind of very difficult macro data territory. And the shape of the tax bill may change entirely. It may turn into a stimulus bill if they're still talking about this in August.
It could too, potentially for farmers, which we heard from Brooke Rollins over the weekend. When it comes to basically then tariffs, which you say they need to deal with this first, what is your base case on what the rates are going to be?
That we're status quo here. It doesn't look like we may be moving to some kind of deals for some of the more kind of friendly trading partners. And that may just mean that the tax rates don't go back up in 90 days to where they were on April 3rd, that we just stay with the 10%. But the big deal that needs to happen is the U.S. and China. The two sides don't even seem like they're talking at this point. So our base case is that these remain in place, perhaps unless and until there's enough political pain that the U.S. has to unilaterally come down. I think that's the most likely scenario, along with they just stay in place. And then a kind of a durable deal that lowers rates on both sides is probably our third base case.
It's hard to come up with a single base case right now, which is why you've got three at the moment on trade. And corporations in America have got to deal with the same thing. Lisa, looking through these earnings from UPS, can't provide an update. Seeing it from other companies choosing, though, to offer that clarity, even where there is none.
I was looking at Hilton earnings, which also just dropped, and this defies all of the narrative that we're hearing about consumers falling off the cliff. Their full-year adjusted earnings per share is actually above expectations. They increased their full-year forecast for adjusted EPS, seeing the upper range. That said, net income is coming in below expectations. So you look in this, it's really mixed, and you start to wonder how much of this is cost-cutting, how much of this is Tom Keene's favorite expression, adapting and adjusting, which is what you see from a lot of companies when they cut on the margins. You also see share buybacks. How much are we going to see this? Because ultimately, if these shares are at a discount and companies believe in themselves, how much do they continue to reiterate and double down on that?
A couple of things to unpack there. Let's start with the resilience of corporate America. Savita Subramanian of Bank of America will join us a little bit later this morning. And the argument she's made, Brian, is that maybe we're underestimating the resilience of corporate America, particularly the names on the S&P. What would you say?
I think that's completely valid. I mean, if you look at the balance sheets coming into this, the reason the companies might be buying back shares is they have cash on hand. Maybe they're not going to be doing the riskier things that they thought they'd be doing this year. Maybe not as much CapEx, maybe not as much hiring. But that means that you have more cash on hand to, raise your dividend, buy back stock, the things that can be sort of more temporary, but things that are friendly to shareholders. I think there's a validity there, and I think it's true on the consumer side too. We're coming into this in pretty good shape with the consumer. We fought off a recession in 2023 that looked like the same thing, with all the soft data looking like it was going to be terrible. Companies very cautious on guidance, and we ended up getting out of that okay too. So I think part of that is because consumers and corporations are both kind of flush right now.
Brian Nick of NewEdge Wealth is going to be sticking with us. Equity futures on the S&P just about positive. We're high here by 1/10%, with an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara Hacker. So, Yahara.
Hi, John. We start with UPS. Those shares are up 4.3% in the pre-market after the company reported first quarter earnings that beat analyst estimates. Still, it said it would not be providing updates to its previously issued yearly outlook due to macroeconomic uncertainty. We've heard that before. Shares of Deutsche Bank, meanwhile, rising in German, trading up 4% after the bank reported a record first quarter, getting a boost from market volatility. Revenue for fixed income and currencies jumped 17%. Deutsche Bank CEO said the results put the bank back on track to deliver on targets this year. And Spain's power system is back to normal, according to the grid operator. Spain and Portugal were hit by an unprecedented power outage around noon yesterday, bringing both countries to a standstill. Train passengers were stranded while millions were left without phone and internet access. The cause of the blackout is still unknown. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, looking to strike a trade deal.
When can we expect the first trade deal?
I think it could be as early as this week or next week. Vice President Vance was in India last week, and negotiations are coming along quite well with them.
That conversation up next, live from New York City this morning. Good morning. What a run on equities. 5 days of gains on the S&P 500, the longest winning streak of the year so far. Equity futures on the S&P up another 0.2%. On the Nasdaq 100 up by a similar amount. Academy's Peter Chair. It's difficult to have conviction with so many moving parts in a market where 1% in stocks or 5% in bonds seems like a normal intraday move. It certainly feels that way, doesn't it? Really volatile stuff over the last 30 days or so. Under surveillance this morning, looking to strike a trade deal.
When can we expect the first trade deal?
I think it could be as early as this week or next week. Vice President Vance was in India last week, and negotiations are coming along quite well with them. As I've mentioned, some of our Asian trading partners have come with very, very good deals. We're evaluating those, and President Trump's going to have the final say on all of them.
So here's the latest this morning. The Trump administration sounding optimistic on trade talks, expecting deals to be announced in the coming days. The White House also signaled some tariff relief might be on its way for automakers. Joining us now is Tyler Kendall, live from Detroit. Tyler, welcome to the program. Walk us through what we can expect later this evening.
Yeah, hey, John. Well, a White House official tells us President Trump is set to ease some of the impacts from his auto tariffs. That includes preventing the so-called stacking of tariffs so that automakers don't have to pay levies on top of each other, including that 25% tariff on steel and aluminum imports that you mentioned. We're also expecting some modifications when it comes to auto part tariffs, not necessarily the rates, but that car makers could apply for some partial reimbursements here going forward. But we should make clear at the moment, we are not expecting the auto tariff rates themselves to actually be impacted. Of course, there's the 25% tariff currently in place on fully assembled foreign-made autos, and then we are expecting a 25% tariff on auto parts to go into effect on Saturday. But still, officials contend that these moves are meant to be a reprieve, meant to give manufacturers more time to reshore their production in places like Michigan, where I am, and where, of course, as you mentioned, President Trump will be later tonight. He's headed to Macomb County. It's about an hour from where I am in Detroit, and it's considered to be an auto hub, a hub of production, and home to many of the workers that this White House contends that his policies are intended to help, even as perhaps amid all the uncertainty, they could also face some of the biggest harms when it comes to this. In fact, a Macomb County official does tell me that the area is home to about 338 auto manufacturers that employs about 22,000 people in this area. So, John, it is really no coincidence why President Trump is expected to be here tonight as he marks 100 days in office.
Tyler, I'm sure we're also going to hear about the tax policies. We're going to hear from the Treasury Secretary as well later this morning. They're clearly trying, almost desperate, to move the conversation forward. What do we know right now between where the White House stands and Congress stands about how quickly they can get reconciliation done?
Well, Annmarie, the Treasury Secretary, said yesterday that he would like to see this ultimately done by July 4th. But then we heard from Senate Majority Leader John Thune, who called that an ambitious timeline, and that really the X date is going to serve as the date that really spurs Congress on when it comes to this. That has been set around, late summer, early fall. I did actually speak to one senior aide to Republican Senate leadership who told me that they are not expecting the Senate to move on this until likely August. So that gives us a little bit of firmer guidance or more of a timeline when it comes to what lawmakers are actually aiming to accomplish. But still, House Speaker Mike Johnson contends he wants his conference to get this done by Memorial Day. Of course, both chambers have to agree here, work on their own separate legislation. But to be clear, all of these timelines at the moment seem to be pretty ambitious because there are a lot of disagreements between the two chambers, including on tax cuts, what's actually going to get through as they work with the Senate budget blueprint, which includes about $5.3 trillion in net tax cuts. And they want to see other priorities like no taxes on tips, overtime pay, Social Security. But at the end of the day, they're going to have to come up with some more pay-fors to get all of those goals accomplished.
Hey, Tyler, thank you. Appreciate the update. More from Tyler later on this morning. Tyler Kendall there. Aspirational, I think the Senate Majority Leader called it, aspirational, targeting Independence Day.
Aspirational is exactly what he called it when it comes to trying to hit this July 4th Independence Day timeline. It's going to be incredibly challenging, which is why, and Secretary Bessent has said this to me, it's pretty much why they're making sure that they're raising the debt ceiling in reconciliation, because Congress actually needs a hardcore deadline or really nothing gets done.
Brian Nick of NewEdge Wealth is still with us. Brian, we talked about a base case. Let's go through some of this. No tax on tips, no tax on Social Security, no tax on overtime. What can we do down in Washington?
I was pretty skeptical that these were actually going to be in the bill, but it looks like they are going to move forward with them. The question is, how long are they going to be there for? I mean, they can do this for a year or 2 years or 4 years, but they probably can't do all of this for 10 years and still pay for it and under all the rules. The one silver lining of the tariffs is it probably gives them enough revenue to push the X date back a bit. If the tariffs stay where they are and we're really collecting as much as we have been in the first couple of weeks here, the X date doesn't have to be in August. It could be potentially as late as October, which gives them a bit more breathing room. It sounds like congressional leadership doesn't necessarily want that. They would prefer to have everybody act over the summer and get this done. But we know from the 2017 experience, they kicked this all the way through to the end of the year. They pass it at the very, very last moment, which is what Congress is going to tend to do.
But the market wants to see it as soon as possible. Is the market, though, pricing in basically this is an end-of-the-year story?
I think the market's pricing in that they have to extend the current individual tax credit rates, and maybe we get some other sweeteners in the form of these no tax on tips, no tax on Social Security. But I don't think there's going to be any permanence in this bill. I think you'll see as assuming the economic situation is softer in July and August than it is today, it's going to be harder to pass the things that are the pay-fors in the bill, like taking away some of the tax credits for energy, it's going to affect some of these congressional districts most acutely, taking away parts of the IRA, cutting potentially some of the Medicare reimbursement, the federal formula, That's going to be harder to do if the economy is weaker. And so I think the longer this goes, the more this is going to be sort of a pure tax cut and deficit increasing bill, and it's going to feel more like a stimulus bill.
You're getting into some of the back and forth we're going to see from a lot of different caucuses within the Republican Party, those that don't want Medicaid touched, those that actually want the IRA credits because their districts are using them. What do you think really does get cut when it comes to things like Medicaid? Can Republicans really sign up for that 18 months before a midterm election?
It's going to be very challenging. And the people have already wrote letters, the moderates have already written letters saying we don't want to do this. They're going to find a way to try to cut this without saying they're cutting it, looks like. There's no way to get all these tax cuts through for even 5, 6, 7 years without also doing some of these spending cuts. And that's just where the money is. And you've had the president already on record saying we're not touching Social Security, we're not touching Medicare, and also occasionally we're not touching Medicaid. So there's no place to get the money. I think we'll probably see some of the federal reimbursement formulas, sort of the payment sharing, some of the eligibility potentially change as well. That seems to have sort of that baseline of popularity in the party. But like you said, they can't lose that many votes on either side of this.
You said that it'll feel like stimulus. It'll be straight up deficit spending. That's the more likely path. Why is that not making you optimistic in equities?
Because the way we get to that point is that things have to get worse, right? In order for all these Republicans that don't want to do deficit increasing tax cuts to agree to this, you have to have a worse economic situation in the interim so that you can have a bailout for some of the affected industries, potentially a farming bailout, potentially just checks written to individuals who are being hit by the tariffs. I mean, that you could easily see that by August or September if this is being debated.
I can hear the roar of bond traders with pitchforks getting up in arms as they hear about this, given all of the uncertainty around the potential deficit. Yesterday, the Treasury released its latest quarterly borrowing estimates, and they had a bit of a rounding error of more than $400 billion. That is how much bigger their quarterly borrowing estimate is for the second quarter of 2025 than initially forecast. How much is the Treasury running out of cash and needing to borrow more and more and more going to stress the market in a way that possibly puts a cap on how much of a stimulus that this actually can be, at least for equity markets? I
think one of the things, just given all the news around tariffs, one of the biggest whiplashes that people are missing is that this went from optimism on spending cuts to now I don't think people are really talking about that anymore. I mean, it's not clear that we're seeing any significant spending reductions from the DOGE cuts. It's not clear that we're going to get significant spending reduction in this tax bill, assuming it comes in a couple of months when things are getting softer. The question, and we haven't seen a reduction in interest rates, despite the fact that the Fed cut at the short end 100 basis points last year. The 10-year is still basically where it was. So there's no room to find sort of good news for the Treasury in terms of the borrowing costs. I think the only thing you can look at is if there's more optimism about passing this and having the economy sort of reflated potentially in 2026, that's going to be better than the alternative, which is you get a recession and then the government has to spend a lot more money. We know, like, as big as the deficits are today, they would be even wider in a recession when you get all these automatic stabilizers kicking in. So if it's like we're not going to have a recession because we're stimulating the economy today, that might be good news for the bond markets.
That's actually the question I wanted to ask you. You talked about the incoming tariff revenue. What about the loss of revenue elsewhere, the loss of tax revenue elsewhere because of those tariffs? How does one offset the other?
Yeah, I think in total, if you're talking about sort of over the long term, the tariffs are not going to raise as much revenue as they offset from things like corporate profits taxes, individual income taxes. If incomes are going down, people are losing their jobs potentially. I think in the interim, though, as this money is coming in, you'll see it used. I don't think it's going to be earmarked in the legislation, but you'll see it used as an excuse to, okay, look, the Treasury has a lot more balance at the Fed. There's more cash on hand, so we don't have to worry about the debt ceiling quite as soon.
Lotfi Karui of Goldman Sachs sat in your seat just yesterday, and he made it clear from his standpoint, his opinion, that when we go into an economic downturn, bonds will rally, treasuries will perform. Do you share that confidence?
Yes, still share the confidence. Don't think we have a credit issue yet in the U.S. So at the end of the day, if things really do look bad, if we're seeing big negative payroll numbers, I think you will see the 10-year yield fall. It does seem like the hurdle to get there is a lot higher than it used to be. The fact that bonds are only up a couple of % year to date, with all that we've seen with the negative news in the equity markets, with the downward revisions we're seeing to GDP forecasts, seems like they're just plummeting every day. The economic consensus, the fact that we haven't seen the long end fall by more tells me that we're not in the same territory that we were 2008, 2015, or even 2024.
Brian Nick of NewEdge. Good to see you, sir, as always. Brian Nick there of NewEdge Wealth. The number one question, I think, that investment committees have been grappling with, Lisa, over the past few months.
Yeah, our Treasury is still a haven asset. And one thing that you noted was 5 straight days of U.S. equity gains. Well, guess what? We've also had 5 straight days of Treasury gains. And normally, okay, everything rallied, great. In this case, is it? Because ultimately, it's either a pro-America or anti-America trade on. And that isn't necessarily supportive to this idea of that ballast.
Equity futures positive here by 0.2 0.2%. Up next on the program, looking for clarity where there is none. Lee Klasko of Bloomberg Intelligence as UPS backs away from full-year guidance, and we're looking for the latest numbers from General Motors. All of that coming up next from New York. This is Bloomberg. Earnings season in focus. UPS out with numbers just moments ago. No update to full-year guidance given what they call macro uncertainty. The next numbers to drop from GM, we'll get to that in just a moment. Equity futures on the S&P positive by 0.25%. 5 straight days of gains for stocks and bonds with 3 hours to go until the opening bell. With your morning movers, here's Danny Berger. Hey, Danny.
Hey, John, I wanted to show you what UPS is actually doing because given what you just said, that they scrapped their guidance, you might think that they were down this morning. No, in fact, they're one of the biggest movers to the upside on the S&P 500 in the pre-market session, up 4 1/3%. Now, along with scrapping guidance, specifically citing macroeconomic uncertainty, they're also undergoing this project to slimming down. They also announced that they would eliminate some 20,000 positions in response to pulling back on some of the Amazon deliveries for 2025. Also, one of the biggest gainers pre-market for the S&P is the industrial giant Honeywell that is up nearly 5%. Unlike UPS, they did give a full-year guidance, and it's something that perhaps the market is taking comfort in because within their range, they have raised the midpoint of it. But the CEO there did point out, look, as we get later into the year, things will become less certain. You can also see that in the guidance, the top end, they still did trim down, but still those shares higher. So those are the two biggest gainers on the S&P pre-market. The biggest loser is NXP. This is the semiconductor company. It is down nearly 9% this morning. They've announced that their CEO is retiring, that he will be replaced, but Bloomberg Intelligence pointing out he's retiring at a young 56, which seems to indicate some structural issues at the company. They also said that life is getting harder for them because of tariffs, and they are still working through a COVID backlog. John.
Danny, thank you. Here comes another one. This from the Wall Street Journal and the New York Times. GM pulling profit guidance, citing what they call significant tariff impacts.
Yeah, the CFO, Paul Jacobson, coming out and saying we are not going to give any more forward guidance on tariffs until we have more clarity. He went on to say we don't want to put out a number from the company that is a guess amidst what the administration might do. So yet another one saying, look, in our honest assessment, how can we give you any honest assessment of something that is just profoundly unclear?
Rescheduling the call to Thursday, May 1st. That's the latest from GM this morning. The stock's slightly positive, up by 1.4%. We'll come back to this story in just a moment, but just to wrap things up so far this morning, no update from UBS, the full-year guidance. Why? Tariffs, what they call macro uncertainty, and a blunt assessment from GM this morning, pulling their guidance as well. Can't contemplate the impact of tariffs. I think we're all struggling with doing the same thing. On our radar this morning, some relief maybe for the autos. President Trump on track to lift levies on foreign auto parts and provide a reprieve from separate tariffs on steel and aluminum.
Well, this is exactly why GM is saying it's really difficult right now to say what it's going to look like for the rest of the year, because this is what they're thinking of doing today. We didn't know about this until 24 hours ago. So basically what the administration is saying is we're not going to hit you on multiple levels of the different levies that we have right now. So if you're paying an auto tariff, you're not going to have to pay the aluminum and steel tariff. And then potentially there's going to be on the margin some reprieve when it comes to auto parts. This is a huge welcome and sigh of relief for the likes of Ford, GM. The problem is they're still uncertain about if there's going to be even more relief when it comes to autos. And they are calling the administration almost every single day, trying to get clarity on this issue.
Bloomberg's Craig Trudeau will be with us in just a moment to run through these numbers from GM and the lack of an update to guidance given the policy volatility we've seen over the past few weeks. China responding as well, reiterating the US trade talks are not underway and urging countries to not cave into US tariff threats. China's foreign minister saying he supports normal business cooperation between the two countries.
So it's kind of speaking out of both sides of the mouth. On one hand, you have Chinese authorities coming out and doubling down on a very nationalistic type of tone, saying, look, we're not going to cave. We're not going to give in to bullies. It's a very rah-rah type of speech. And then on the flip side, there is this sense that on the margins, China is willing to cooperate because the financial pain is significant. It speaks what we were talking about yesterday, and there's a Bloomberg story about it today, about how much Beijing has welcomed the groundswell of support that they've gotten from the local domestic audience, given the fact that they now can blame one person for all of their problems that have been in the making for a long time.
I think it's fair to say that Mark Carney has welcomed that as well. Canada's Liberal Party, led by Mark Carney, set to win for a fourth consecutive election. The party narrowly winning 43% of the national vote. Carney pledging to strengthen Canada's economic independence and stand up to President Trump.
This U-turn is pretty incredible when you think about the Liberal Party in Canada, given the fact where Pierre Poilievre was at the start of the year. There was this immense fatigue when it comes to three-term Trudeau administration. But then, of course, Donald Trump started to be antagonistic on Canada when it comes to trade, when it comes to things like making the 51st state. And then you saw this rallying cry behind Mark Carney, and then he was able to pull it out last night.
I remember back in 2016, shortly after the Brexit vote, the Prime Minister disappears, the Chancellor can't be found, there was one man left standing. Now, whatever you think about Governor Carney and how he handled Brexit at the time, the leadership that he provided in that moment, I can tell you there was no one else there. He was like the beacon of stability, the port in the storm. And that's been the pitch to voters in Canada over the last month, exactly because of the tariff volatility down in D.C.
To frame this, and I think you're exactly right, this is someone who ran the Bank of Canada or headed the Bank of Canada during the financial crisis, who headed the Bank of England during Brexit, and now is saying to Canada, during this crisis of confidence with our neighbor, the United States, I will be your port in the storm, to sort of highlight your point. He always just seems to emerge when there's some sort of existential crisis.
He knows how to handle these moments. I was in the room with him back in June of 2016. Several other journalists were all called in shortly after the vote, and it was to calm people down, to soothe nerves. And I think he did a pretty decent job of just that.
Well, hopefully he will have the opportunity to do that. I will say he did get a groundswell of support, but not quite as much as people expected. And he doesn't have the majority in the House of Commons. So it could be a little bit messy for him to have the same kind of ballast of support as he did when he was running some of the central banks.
We'll get you an update on that story in about 60 minutes from now. I want to get you an update on the earnings story as well. GM reporting earnings just moments ago. Craig Trudeau joins us now for more. Craig, welcome to the programme. I think we have to start with the guidance or lack thereof. What's your response to what you're seeing this morning?
Yeah, I don't think it's a huge shock to see the company back away from the numbers that it had given investors when, it's been, a matter of hours that the administration has changed yet again its approach to automotive tariffs. I do think that the relief that the administration announced last night will be helpful on an incremental basis, but it is still a matter of, saying we're not going to do, sort of the most out there thing of stacking tariffs on top of one another. We are still, however, going to hit, parts and car imports, and that is still going to be extremely disruptive. And so, you have the CEOs of companies in Detroit coming out and saying, thank you, Mr. President, for not doing the worst. But if you parse their statements closely, they're saying that these moves will mitigate the damage. It won't do away with them entirely. And so how do you sort of, offer guidance with any confidence, given that you don't know just how long these tariffs are going to stick around, and just how dug in this administration is, given the extent to which they've kind of taken one step forward, one step back over and over again.
So, Craig, lots of questions here for the operational side of the business, but also I think for the capital return programme, the buyback over at GM as well. What does this mean for that, Craig?
I mean, that's been, sort of Mary Barra's calling card, right? Where this is a company that, hasn't done everything right. The strategy has been to try and, kind of replicate Tesla and get people excited about GM's electric vehicles. And for years, it was also to get them excited about self-driving and autonomy. I think the electric vehicle side is picking up momentum, but they had a significant step back on, the self-driving side and did away with Cruise, essentially absorbed that business. But all the while, the sort of old school business within GM of making big trucks and SUVs has done quite well. And, Barra has managed this company in a way that has allowed for them to do a lot of returning to shareholders. And to the extent that can't continue this year because of the commands on the company's cash, dealing with tariffs and potentially making some investments that it might not have otherwise as a result of these levies, it may be a setback to some of the momentum that we've seen with GM in the Mary Barra era.
Quite clearly. Craig Trudell with the latest out of London from Bloomberg. Craig, thank you. The latest on GM, if you're just joining us. So the first quarter, adjusted EPS coming in at 278. The estimate was 272. The guidance from the company, pretty clear that prior guidance can't be relied upon because they didn't include the impact from tariffs.
Yeah, and they also did they froze that share repurchase program, which had been the hallmark of Mary Barra's whole plan, was to try to, as we were just hearing from Craig Trudell, replicate what they saw over at Tesla. How can they justify using their free cash at a time where they say that they have no understanding of how the path forward is going to look like?
GM this morning down by about 4% in the pre-market. Another company to look at is UPS. Joining the list of companies halting guidance, the company saying it will not provide an update to its 2025 outlook despite delivering better than expected first quarter earnings. Lee Klaskow of Bloomberg Intelligence joins us now for more. Lee, welcome to the program, sir. Let's just start with the numbers. Did you like what you had to see this morning?
Yeah, I mean, given all the noise of the economic uncertainty in the background, I think this morning's print by UPS was some good news for the company that's in the midst of a transformation. And that transformation is going to get, I guess, a little bit bumpy because of the uncertainty that's out there. And that's really why management is pulling their, decide not to give guidance going forward, which to us makes complete sense. We were actually surprised a lot of our companies have maintained their guidance during this uncertain time. And, I think overall, UPS had a pretty good print. The beat was really driven from our vantage point from the volume side, especially as it relates on the domestic business. Domestic margins came in better, which is kind of telling us that maybe some of their cost controls that they're working through their networks are starting to pay off. The company is continuing to restructure itself to deal with the new realities of demand, even excluding all the U.S. tariff and de minimis noise. And some of that is, walking away from Amazon business, which accounted for about 12% of their revenue at one time. And they're just doing that because it's low margin business and they feel that they can fill their network with more profitable freight.
UPS used to be a real bellwether for the U.S. economy. It's gotten complicated by some of the rivalry with Amazon and some of the other competitive landscape issues. I am wondering how much of the volume that you saw increase is due to pulling forward of orders ahead of the tariffs, whether this is a one-time type of boost that will come at the expense of volumes later in the year.
I think it definitely had something to do with it, that pull forward effect. I mean, it's been telegraphed that tariffs are coming and some shippers, especially more sophisticated shippers, want to make sure that their inventory are positioned here in the United States before those tariffs go into effect. And I think we saw some of that. I'm not quite sure if that's 100% of what's driving the volume beat. But, it'll be interesting to see what management has to say during their earnings call later this morning about, what their customers are saying to them. But, given the fact that they are not providing guidance, I think their customers are just, sitting at the sidelines waiting to see how this plays out, this trade war plays out with the rest of the world on global freight demand.
Lee, when it comes to de minimis, which you mentioned earlier, how much of an impact is that going to have, closing of that loophole?
Yeah, they don't really give specific numbers on their volumes. We guess it's, low single digits of their volume. And that de minimis stuff, so what happened is the government's getting rid of the exemption for freight less than $800. Those shipments usually, when they come in, they get cleared through customs and they don't really have to pay a tariff. Now they're going to have to pay that tariff. And a lot of those volumes are from Chinese e-tailers like Temu or Shein coming into the United States. So those companies are going to have to change the way they do business. Either they're going to have to position that freight here in the U.S. Or face these tariffs. So that's definitely going to have an impact. And the growth that we've seen late last year and probably to some of it in the first quarter has been driven by a surge in that demand here from the U.S.
Hey, Lee, good to catch up. Thank you, sir. Lee Klaskow there of Bloomberg Intelligence, the latest on UPS. Equity futures at the moment just rolling over, slightly negative now on the S&P 500 following these results out of corporate America in the last 40 minutes or so. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Goldman Sachs CEO David Solomon sat down with Bloomberg's Francine Lacqua earlier and discussed the impact of President Trump's first 100 days in office.
I'd say 100 days in, we need another 100 days to kind of see where the policy directives are going and to try to have a better understanding of how what's talked about so far, particularly with respect to trade, is ultimately going to be put in place, how it's going to play out. But the policy actions to date have raised the level of uncertainty to a degree that I don't think is healthy.
Salman also said he expects companies to announce layoffs due to uncertainty around policy. Meanwhile, GM shares are falling in the pre-market, down nearly 3%, despite reporting earnings that beat estimates. That's because the automaker is pulling its 2025 profit guidance and putting $4 billion in share buybacks on hold. GM saying President Trump's auto tariffs have clouded the outlook and its prior forecast can't be relied upon. And American Airlines ended discussions with JetBlue to revive a pact for the two airlines to team up. American's vice chair and strategy officer told staff that JetBlue was, quote, focused on different business priorities. The company also said it filed a lawsuit against JetBlue to recover money from the unwinding of their prior pact. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, counting you down to payrolls.
We're generally expecting that the labor market data is probably going to look okay through the May data. It's probably not really until sort of June, July, August timeframe that we really see, the impact of some of the uncertainty and the tariffs on the labor market.
The payrolls report just a few days away. Up next on the program, Stephanie Roth of Wolfe Research from New York City. This is Bloomberg. There's a theme emerging this morning from General Motors. Prior guidance didn't include the impact from tariffs. No update to guidance from them because of that. Seen this elsewhere as well from UPS, not updating the outlook given the macroeconomic uncertainty. And just moments ago from Pfizer, guidance doesn't include the impact related to future tariffs. Equity futures right now softer by 1/3 on the Nasdaq 100. We're down by 0.4 on a Russell. A bit softer also negative by 1/3%. Under surveillance this morning, counting you down to payrolls.
The labor market's holding up pretty well. We're generally expecting that the labor market data is probably going to look okay through the May data. We've been expecting that it probably will soften relative to March, but that it's probably not really until sort of June, July, August timeframe that we really see the impact of some of the uncertainty and the tariffs on the labor market.
So here's the latest this morning. Our survey here at Bloomberg showing economists looking for 134,000 jobs added and unemployment to hold steady in Friday's payrolls report. Stephanie Roth of Wolfe has one of the lowest estimates on the street, writing we're looking for 90,000 non-farm payrolls. Weather, seasonal factors and the calendar alone suggest a substantial headwind. Stephanie joins us now for more. Stephanie, good morning.
Good morning.
Is it too early to expect to see a hit from the policy volatility down in Washington?
No, I think we should start to see that companies probably pause on their hiring. If we don't know what the outlook is, a lot of companies are quite uncertain about where things are going. It makes sense that they're going to pause on hiring. And then from the comments that you just read, there's seasonal factors weighing on the print, calendar factors weighing on the print. It makes sense for it to be below 100.
Has been described as a random number generator at time. In the survey week, claims are okay. Does that make a difference to you?
No, because the seasonal stuff is not really an effect of firing. It's more just timing around the survey week compared to last month. There was bad weather. That doesn't mean that there was actual firing, so that shouldn't correlate with the claims data. This is more a function of this particular non-farm payrolls print.
Does it matter which jobs end up getting removed or maybe seeing a weak performance in this report, given the fact that there has been this ballast of healthcare, as well as a couple of other sectors, including the government, that have really driven things over the past couple of years?
Yeah, and I think that's something that we're going to see over the next couple of months is the parts of the labor market that were really strong should start to slow down, government in particular, healthcare as well, especially since grants are likely to be slowing down healthcare hiring. And then on top of that, you should start to see the cyclical parts of the economy slow down. That one I don't expect for this print necessarily. I think we should see a sort of more gradual slowdown from that perspective. But we should start to see construction, should see a headwind from some of the weather stuff. Healthcare, government should be a little bit softer in this print. And then in the next print, things like rail employment, stuff that's actually tied to the goods economy. That's probably less of a story for this print. It's probably more about the May payrolls print.
You know, this has been a really confusing moment. On one hand, a lot of people are predicting a lot of pain and potentially a real headwind to growth. On the other hand, you do have companies withdrawing guidance. You have others, like some of the travel companies, cruise liners, and hotels increasing their adjusted full-year forecast because they see people still traveling. People still want to go around. The consumer is still strong. How do you pair these two ideas and put them together in some sort of outlook?
I think it makes sense. Today, the economy is fine. There will be some significant headwinds in the next couple of months unless Trump pulls back the tariffs on China in particular in a big way. So if he doesn't do that in the next couple of weeks, we might be on a sort of unsustainable path towards recession. Base case is he probably pulls down the tariffs on China in particular fairly notably in the next couple of weeks. Otherwise, we might be looking at bare shelves and COVID-like environment, but it was a self-inflicted one.
Stephanie, what's fairly notable in terms of pulling the tariffs down? 60%? That still feels like to many people a trade embargo.
You need tariff rates to be below 55% roughly, all in. That includes the fentanyl tariffs. That includes the reciprocal tariffs. And then, by the way, you have to be cognizant that there are 301 tariffs from the last trade war as well, some of them up to 25%.
Right, so it's a massive cumulative rate. You said something earlier. You said you don't expect companies to be hiring. They're on pause. Do you expect them to be firing at this moment?
At this moment, probably not. There's just so much uncertainty. There was so much difficulty hiring in the past couple of years. It probably makes sense for them to just pause for a little while. Of course, there's going to be still some hiring to some extent. There's just a business needs. The economy is still growing. But to the extent that at the margin, if you're not sure you need the position, you might just kind of wait for the next couple months, see how things play out, and then make a decision about whether you actually want to hire that position.
Later on this morning, we get consumer confidence numbers. And within that, you're offered a read on attitudes to the labour market, how difficult or hard it might be to get a job. And I think this is really important on taking the temperature, not only for that, but also the potential for second-round effects when it comes to inflation and price hikes. Now, if I'm worried about getting a job, how likely is it that I'm going to get a pay rise anytime soon, or at least ask for one?
Probably less so. So you're probably going to start to see a little bit of a deceleration from a wage perspective. The one thing is, the immigration stuff actually has a different implication for the blue-collar worker at the lower end. So there's a bit of stuff happening kind of under the surface that is quite nuanced. So we might start to see an unusual tightening for the blue-collar worker, even though the white-collar worker might actually be having a little bit more difficulty finding a job.
So just for the record, ask for a pay rise, right? Okay.
Really?
Always.
Okay, so that's you're basically so in sum, please. Rachel?
This can become self-fulfilling, don't you think? That people start to worry about these things, so they back off, they stop spending, and it takes on a life of its own. Which
is the reason why I think it's really salient that you mention these surveys and how people feel about their jobs, people staying longer. The quits rate later this morning when we get that JOLTS data is going to be key in terms of people's confidence, not just to ask for a raise, but to leave their jobs. And as we're talking about this, UPS announces plans to cut 20,000 jobs this year as a result of the Amazon tie-up. You're seeing this on the margins, cost-cutting coming more into the fore.
Where is consumer price tolerance right now, going into potentially higher prices?
Not very high. So the biggest driver of consumer inflation expectations is past inflation. So to the extent that consumers are worried about the inflation that we saw this time, they're quite worried about inflation that we're going to see in the future, in which case they're probably going to be pulling back on spending. They're going to be very attuned to the prices that they're seeing on the shelves. So this is very different than the last trade war for a number of reasons, magnitude, of course, but also where we are coming from. And in 2018, we didn't have a period of inflation. People weren't really expecting inflation. They didn't really know what it felt like. This time, consumers are very, very different versus where we were.
Amazon has a different idea of how this might play out, right?
Amazon, I think, is going to get very political. The Trump administration is not going to like this. Punchbowl says that they're going to add what the tariff rate is on top of the cumulative price. So if you're a consumer and you see something's $5 and now it's 10, 7, whatever, you see the additional tariff input. That is going to, I think, really irk the administration.
Yeah, the politics of that is going to be interesting over the next few months or so, if that's how it plays out. Stephanie, it's good to see you, as always. Thanks for dropping by. Stephanie Roth there of Wolfe Research. In the second hour of Bloomberg Surveillance, we'll catch up with Matt Stucky of Northwestern Mutual, Rob Casey of Signum, Global Advisors, Collin Martin of Charles Schwab, and Mandeep Singh of Bloomberg Intelligence. 48 hours full of tech earnings. That kicks off tomorrow.
overall has just been better than expected in terms of earnings.
The short term is going to be very challenging for a number of companies. So I think it is still going to be a really challenging quarter ahead.
If you assume we kind of muddle through this year, it's kind of reasonable to be where we are.
Overall, across the board, these companies are going to sustain their CapEx spending plans.
Short-term volatility that then can resolve itself. The concern is, of course, is if we cannot have some certainty in the markets.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, following 5 days of gains for stocks and bonds. Equity futures this morning negative by 0.1% on the S&P. On the Nasdaq 100, also softer, negative this morning by 0.12. In the bond market, Treasuries a little weaker, yields a bit higher across the curve by a single basis point. On the 10-year, up by close to 2 to 422.74. Going into a busy morning, 8:30 Eastern Time, you'll hear from the Treasury Secretary in a press briefing from the White House. Look out for that a little bit later this morning. After that, some economic data, job openings and consumer confidence as we get a read and take the temperature on confidence in corporate America, and confidence is not that high.
You have UPS, you have General Motors, you have Pfizer coming out and basically saying, you're really expecting us to give any sort of guidance? No way. How can we? Because the macroeconomic uncertainty, the inability to forecast seems to be a real concern. You are getting guidance from elsewhere, but here lies the issue. There are pockets of such deep uncertainty that corporate executives like GM are postponing calls even with their investors because they're saying ultimately we don't really have a sense that things are moving that quickly.
The president heading to Michigan later on this evening to mark 100 days of his second term and offering some relief potentially to Detroit. That's in focus. Plus, doubling down on the tax cut effort in the nation's capital.
So he's going to be in Michigan. This is obviously the automotive hub of the United States. And at this moment, he's going to say, I hear you, automakers. I'm going to help you out. There's going to be some reprieve. You're not going to have to pay double taxation, double levies when it comes to the tariffs, even though we see that that's not helping at this moment. GM, Ford, they need to digest all this and get concrete affirmations on what this administration plans going forward. And then obviously, Jonathan, it is so clear from everything you hear in Washington, D.C., they are desperate to move the conversation forward to talk about taxes. And I'm sure that's what the Treasury Secretary is going to really want to lean into this morning when he briefs the press.
This word uncertainty has been overused over the last month or so. You always have to deal with uncertainty in the market. The difference with this kind of uncertainty is the following. At Goldman Sachs, as David Solomon put it well, it's unhealthy because it's leading people to do nothing. It's the wait-and-see economy, and we've all gone back to what Jim Zelter many months ago said over at Apollo, macro paralysis. It's the paralysis of this that is problematic.
There is a level of uncertainty that has to do with we don't know what's going to happen, but we can have a range of parameters to understand exactly what could happen given the rules of the game. Now the uncertainty is about the rules of the game at a time when potentially you could have a real upheaval of the global order. You're seeing a lot of companies come out and say, ultimately, we can't give you any more information. So what do investors do with that?
We can deal with the shock to the cycle. It's much difficult to understand a shock to the system, something we've repeated again and again on this program. Equity futures on the S&P 500 negative here by close to 0.1%, just a little bit softer. Coming up this hour, we'll catch up with Matt Stucky of Northwestern Mutual as stocks post a 5-day winning streak. Rob Casey of Signum Global Advisors with President Trump expected to ease some auto tariffs, and Mandeep Singh of Bloomberg Intelligence previewing earnings from big tech. We begin this hour with stock steady as the White House signals some tariff relief for automakers. Matt Stucky of Northwestern Mutual writing, while peak uncertainty might be behind us in terms of a trade war, the reality of the highest tariff rates in a century remains. The impact on growth and inflation still could unfold. Matt joins us now for more. Matt, welcome to the program, sir. I think last time we spoke, you pointed to stability in the labour market. Will you be able to point to that at 8:31 on Friday?
You know, I think, Jonathan, we still will have, a fairly decent jobs report. We haven't really seen consumer spending really fall off quite yet. I think consumers are likely to respond in terms of pulling back spending as they see prices rise. And we still have yet to kind of see the full impact of tariffs impact pricing on everyday items that consumers are buying. And so kind of with that means that, the economy is still hanging in there in terms of the hard data today. It's just the future that is more concerning as we think 3 months out from now. When a lot of the price hikes start to really kick in. That we think is a little bit more messier as we think about the labor market, just a few months from today.
Matt, over the last 4 years throughout this cycle, we've consistently underestimated the resilience of the consumer. What's the starting point now for the consumer in America?
Well, I think the consumer right now is like a lot of business leaders looking at the forward outlook and having some concern. We're seeing that in confidence numbers that have really fallen off, both for the consumer as well as for businesses. But we've seen that before. The last couple of years have been marked by a real disconnect between soft data that shows some weakness in the economy, but hard data that stays resilient. And the last couple of years, despite a rapid rise in the Fed funds rate, despite high inflation, the economy has hung in there and avoided recession. We think, though, that this is a little bit different. Policy uncertainty is on a 30-day moving average has 5x'd from where we were in October. And that does introduce kind of higher risk of a lot of uncertainty spilling over to softness in the actual economy as we think over the next couple of months how this might unfold.
Really what exemplifies what you're talking about, Matt, is yesterday we got this Dallas manufacturing survey, which came out at the weakest level going back to May 2020. At a time when basically a lot of risk assets continued to rally. People shrugged it off and said, we're going to watch the hard data because the soft data has been so noisy. At what point do you listen to what corporate executives are telling you and saying, look, we don't feel good. You just have JetBlue cutting their full year capital expenditure budget. There is a feeling the corporate executives are also not feeling well. Does that raise concern for you?
We've seen throughout history that, when exogenous shocks like this happen and uncertainty spikes, the first impact, as you mentioned, is in the survey data. We saw that, as you pointed out, with the Dallas Fed, but you also saw that with Richmond Fed as well as the Philadelphia Fed surveys. Typically, there's a 3 or 4 month lag, though, between survey data and the potential for that impacting hard data in terms of actual spending, CapEx, things of that nature that we can measure that flow into GDP, and that. We're just in this window right now where we see the softness in the survey data, and it's going to be a couple of months until it actually potentially shows up in the hard data. The problem, though, is we don't know what's going to change from a policy perspective between now and then in terms of trade deals, in terms of de-escalation potential between the United States and China. Those are huge unknowns, and business leaders are saying the same thing that we're thinking is we just don't know at this point.
You said that random sell-offs are not random. When you get a sell-off of more than 10%, that typically is driven by either significantly higher interest rates or an increasing jobless rate. You talked about how there's going to be lagging data. Do you think that the interest rate side of things will actually help the cause? That you could see interest rates fall, not rise, offsetting some of that potential pain that could come from a weakening labor market?
I think as you look, you referenced the sell-off. We've had 28 of those since 1960, and as you pointed out, there's a common cause behind a lot of them, and that's sharply higher rates, sharply higher unemployment, or some exogenous shock that causes one of the two to rise. We've seen peak to trough roughly a 20% sell-off, with retracing a lot of those losses in the last couple of weeks. I think what really kind of changes the discussion from correction to bear market is what happens with the labor market. And if you start to see material increase in the unemployment rate, despite the potential for rates to move lower, that's where I think the potential is for corrections to translate into outright bear markets. We'll see what happens. I think as we talked about earlier, the unemployment picture this upcoming Friday is still going to hang in there. So it's likely to be a hard data item that we see unfold and potentially move softer in the coming months.
If you're just tuning in, welcome to the program. Just got a note from Torsten Slok of Apollo. Check this out on the labour market. The survey week for the employment report was the week after Liberation Day tariffs were announced. The consensus expects 130K. There are significant risks the number is going to be lower, Lisa, perhaps even negative.
And so how would this market respond to a negative print? Not well. That's my sense, is probably not well, given exactly what Matt Stucky is talking about, which is this idea that some sort of real hit to the employment market would be the true cause of a bear market.
Matt Stucky of Northwestern Mutual. Thank you, Matt. Always good to catch up with you, sir. Annmarie, this is the pressure that's rising now for the president, captured in the polls as he heads to Michigan to mark 100 days.
You see it really in the polls. The last weekend we saw from CNN, NBC, Washington Post, some of the lowest ratings the president has received in the economy, when really it's these twin issues that he was elected on, the economy and immigration. When it comes to the economy, continuously in these polls, you see a number of consumers pushing back, American voters, on the tariff policy and the concern on what this could mean for inflation and the cost of everyday goods, something he promised to lower coming into office.
There's a huge difference between firing and not hiring. We're talking about not hiring here, not firing. And let's hope that we're not talking about firing later on this year. But when you see this kind of corporate guidance, Lisa, just to go through it, again, if you're just joining us, we've seen this repeatedly throughout this morning across a range of industries. JetBlue not reaffirming the prior full-year guidance. GM, prior guidance can't be relied upon. UPS not updating the outlook given macro uncertainty.
And you did see a number of these companies pull back plans to buy back their shares. Some of them reaffirmed them or even went for it. The fact, though, that they are concerned about preserving cash at the same time that they're talking about uncertainty gives you a sense of what they're girding for. Then you have the likes of UPS laying off 20,000 workers, and you have other companies looking to trim costs to maintain margins. That is code word for look around. Is that person really necessary? And that is maybe what you will end up seeing.
At the start of the year, there was a lot of excitement. There was this view that the administration would be pro-growth and pro-risk and good for equity markets and good for the broader economy. Might still turn out that way, but there are much more doubts, I would say, at this point than there were just 3-4 months ago. The tax plan is going to be a big feature of this conversation over the next several months. When you speak to the administration, when you spoke to the Treasury Secretary, he repeated again, don't just talk about tariffs, talk about the whole policy platform, and taxes are a big piece of that.
He said right now everyone is just focused on tariff, tariff, tariff. But then they need to start focusing on tax, 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 deregulation, deregulation, deregulation. President Trump, the evening before his inauguration, said this is going to be the most extraordinary first 100 days in any presidency. I think many people would agree this has been quite extraordinary. The market, though, is desperate. And this administration, I think, as well, is desperate, seeing all the pushback in the polls as well from corporate America to get the tax bill underway. The issue is right now, all this tax bill is doing is extending current policy. Is there enough for the sweeteners that he promised on the campaign trail? Not sure.
5-day run of gains in the equity market this morning. We stall out just a little bit. We're negative by 0.1%. With an update on stories elsewhere with your Bloomberg Brief, here's Yahara Heckes. Hey, Yahara.
Hi, John. A flurry of earnings have come in, and we start with Pfizer reporting a miss on revenue for Q1, but reaffirming its 2025 guidance, adding it doesn't include impacts related to tariffs. The drug maker also saying it is cutting at least $1.2 billion from its spending after its obesity pill failed. The cuts are part of an effort to save $6 billion by the end of 2027. And you mentioned JetBlue before. It's reporting first quarter earnings that missed Wall Street estimates and saying it's not reaffirming its full year guidance. In a statement, the company saying we expect softened demand for off-peak travel to continue into the second quarter, where the booking curve is more exposed to macro uncertainty and deteriorating consumer confidence. And Spain's power system is back to normal, according to the grid operator. Spain and Portugal were hit by an unprecedented power outage around noon yesterday, bringing both countries to a standstill. Train passengers were left stranded while millions were left without phone and internet access. The cause is still unknown. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, tax cuts.
We're going to see the president's campaign promises, no tax on tips, no tax on Social Security, no tax on overtime.
It's a lot of tax cuts. Rob Casey of Signum Global Advisors joins us next to discuss. Live from New York, this is Bloomberg. This week, lots of earnings, lots of data, and very little clarity on the outlook. Equity futures negative by just 0.04%. JetBlue not reaffirming the previous full-year guidance. GM says prior guidance can't be relied upon. UPS not updating the outlook given macroeconomic uncertainty. And Pfizer, their guidance doesn't include the impact related to future tariffs. These guys are flying blind. On the Nasdaq, we're negative by 0.1%. The Nasdaq in focus later on in the week. Tomorrow, numbers from Meta and Microsoft. And then on Thursday, Apple and Amazon. Under surveillance this morning, tax cuts.
We're going to be having a tax meeting today, but what you can see is that as we go into the tax negotiations are the final stages of the tax bill. We're going to see the president's campaign promises: no tax on tips, no tax on Social Security, no tax on overtime.
Here's the latest this morning. Pressure rising for President Trump's tax cuts on Capitol Hill. A flurry of polls showing increasing discontent with the U.S. economy. Bloomberg's Tyler Kendall joins us live from Detroit. Tyler, we will see an address from the President of the United States later on this evening to mark 100 days of his second term. I want to understand from you whether we will get any clarity whatsoever on this tax bill.
Yeah, hey, John. Well, it's clear that the White House is trying to ramp up the pressure, and very likely President Trump will speak about it tonight. In fact, he actually told Michigan Republicans to stay home, not come to the speech, because he wants them in Washington instead to really get to work on this, as the White House wants to give some sort of relief to consumers amid the tariff fallout. We are getting the administration's requested timeline here. Treasury Secretary Scott Bessent saying that they would like to see the entire reconciliation package done by July 4th. It's something that Senate Majority Leader John Thune called, quote, aspirational, instead saying that the X date really would serve as that hard deadline for lawmakers, the potential date when the U.S. could default on its debt. We are expecting an updated X date number in the next week or two as the Treasury really gets in its finalized tax receipts for April. And I did speak to one senior Senate aide to Republican leadership who told me that they do not expect third chamber to complete work on this until August at the earliest, even as House Speaker Mike Johnson says that his chamber will get done its side of the legislation by Memorial Day. That would be considered to be a very big feat if it is accomplished, because we have to keep in mind, John, this really does have three big pillars in it. It's tax cuts, spending cuts, but then also, of course, lifting the debt ceiling. And all three are considered to be very contentious. And Republicans have very little room for error here because they chose to do this through reconciliation, through a fast track process. But it means they have to agree among themselves because, John, they will not be courting any Democratic votes to get this done.
Tyler, you're in Detroit. How much are the automakers breathing at least a little sigh of relief for some flexibility the administration is showing when it comes to auto tariffs?
Well, Annmarie, we did see automakers applaud this expected move from the administration when it comes to somewhat of a reprieve. We should make clear that we are not expecting the administration to change the actual auto tariffs that are in place. Of course, the 25% tariff on fully assembled foreign autos, and then the expected 25% tariff that will go into place for auto parts on Saturday. But it is considered to give these companies more breathing room to reshore production to places like Michigan, where I am today. And I'd also point out President Trump's going to be in Macomb, Michigan, Macomb County. Actually, we saw an auto worker from that area be at the White House in the Rose Garden next to President Trump on so-called Liberation Day. So really no coincidence that President Trump is focused in on this area, of course, one of those big production hubs, as he tries to float some relief to these automakers.
Tyler, thank you. Tyler Kendall of Bloomberg. More from Tyler throughout today on Bloomberg TV and on Bloomberg Radio. Let's extend the conversation. Here's a thought from Rob Casey of Signum Global Advisors, writing, expect continued turbulence as congressional Republicans move towards a final reconciliation package. Speaker Johnson's Memorial Day target is nearly impossible to meet at this stage, and we think even a July target is optimistic. Rob joins us now for more. Rob, good morning.
Morning.
What's the biggest point of tension that holds that up?
Well, I think the biggest point of tension is the fact that there are a million points of tension between Senate Republicans and House Republicans on the level of cuts, between Senate Republicans and House Republicans on the level of where the debt ceiling will land, and frankly, probably most of all between Trump and House Republicans on just how many of these new tax policies will be included in the final bill.
What do you think actually gets over the finish line for the new policies?
Well, I mean, if we're thinking about no tax on tips, no tax on overtime, no tax on Social Security, in that order, least expensive to most expensive. So I think no tax on tips between 100 and 200 billion over the next decade, that probably fits in. But if we're talking about, at the far end, no tax on Social Security, $1.5 trillion over 10 years, I know President Trump continues to say, and we just heard from Scott Bessent, that all of it will be included. I think it's really hard to square that circle.
So that's what they want to add. What are they taking away? What's happening with SALT? What's happening with things like IRA provisions that some Republicans really want to keep because it's impacting their districts? Who wins out in this fight?
So on SALT, I think that there has to be some sort of relief for New York Republicans and California Republicans. We've heard that from them time and time again. They've said that even doubling the cap to 20,000 per person is not enough. I think we probably land somewhere around there, right? 20, 25, 30. On the IRA, like with a number of other sort of stimulative packages, The issue for Trump and Republicans is that we are now, hurtling towards recession, right? The economy needs a little bit of stimulus. And so I think that we're actually going to see less of the IRA pulled out, less of potentially chips pulled out than President Trump had signaled previously. Otherwise put, there just aren't that many places to cut.
It's very challenging right now where they can cut. You made a point in your notes that Trump holds sway over his caucus. Given what we're seeing in polling, do you think that he's starting to dent that sway?
Well, I think he probably is starting to dent that sway internally, right? But the issue for congressional Republicans is that if they are going, if they're going to push back against Trump externally, publicly, then they are going to get primaried, especially if they do it this early. So I think for the time being, no, congressional Republicans are in lockstep with Trump. I would say with the exception of New York and California Republicans who need SALT relief. It's a mortal challenge for them electorally. So, we talk about the House Freedom Caucus all the time. They're always the ones who like to jump ship and make the most noise when it comes to passing legislation. I actually think that in this case, it's Maliotakis, it's Lawler, it's maybe Stefanik. It's the New York and California Republicans who are generally in lockstep with Trump and relatively quiet, who may make the most noise this time around.
They're trying to change the narrative back to taxes and possibly even deregulation. At the same time, the market's still very focused on trade. And you have a pretty bold prediction, which is that you expect the U.S. and China to really walk back a lot of the tension and see a much lower tariff rate. So did you get President Trump on the couch and kind of seek into his mind? What gives you that kind of conviction?
I wish. I would love a one-on-one with President Trump. I'm sure you all would as well. Well, no, I think there are sort of two levers that Trump can pull, right? There are the retaliatory tariffs on everybody, ex-China, that are set to come back into effect on July 8th, barring, bilateral agreements. And then there's the China level, and we keep hearing this back and forth between who's going to call who, right? It's like, high school dating. Is it going to be Trump or is it going to be she who calls first? And honestly, I would see through a lot of that noise because I think Trump is able to essentially walk back tariffs unilaterally, right? We saw it after Liberation Day. I think we could see it again where all he needs to say is, publish the truth that says we are on our way to negotiations, which will then be on their way to a deal. We believe China's going to come to the table. And in the meantime, we've caused a lot of harm to China's economy. So 145 is going to look like, 30 to 50 to 70 for the next however long. I think that's pretty easy for him to do.
There is this larger question, and I guess it's sort of implied here, which is how much is this administration paying attention to what markets and to what companies are saying and doing? I just asked Julian Emanuel the last time you saw this many companies pull guidance from the forward-looking guidance, and he said it's very rare and probably the last time is the financial crisis. How much does that resonate in the White House?
Honestly, I think over the course of the past month, we're seeing that maybe it's resonating a little bit less than we might have expected, right? There was all of this discussion around what is the Trump put, where is the Trump put in the equity market? Frankly, I don't think it was found in the equity market. It was found in the bond market. And I'm just not sure they're focused company by company forward-looking guidance. It would be great, I think, if President Trump watched this show, as we all do every morning. I don't think he's watching this. I think he's watching Fox more than anything else.
I can confirm he tunes in sometimes, for what it's worth, Rob. But I can confirm also, based on reporting, that the wake-up call came from the retailers just last week. A week ago, the risk of empty shelves, and there is still a risk of empty shelves in the coming weeks.
There is this theory that there's going to be a moment like the egg crisis, where suddenly there's going to be one item that suddenly is triple the price, or their shelves are clear, or people are going to be lined up trying to get into national parks, Yellowstone or Grand Canyon or something, and running out of food from some of the grocery stores, that there's going to be some PR mishap that will really be the ultimate check. Either way, there is a clear tipping point. It just is unclear what exactly that is.
The warnings from corporate America and then unemployment. And let's hope the warnings from corporate America are enough before we get to unemployment.
That's right. Because for Trump, that's really, I think, what you would call the ultimate Trump put. It's the political pushback, what's coming from Americans. And you have to think, he does not want to see empty shelves before back to school. That is going to be incredibly challenging for this administration.
Rob Casey of Signum Global Advisors. Rob, thank you, sir. Appreciate it. A few months ago, the Liberal Party, led by, at the time, Justin Trudeau, 20 points behind the Conservatives, led by Pierre Poilievre. 2 months later, 3 months later, a big win for Mark Carney of the Liberal Party, and Pierre Poilievre loses his seat. What a massive change. The scores look like this on the S&P 500. In 2025, down 6%, down 10% from all-time highs for April, down just 1.5% this month, and down just 2.5% since April 2nd. If you ask people to guess without looking, I'm not sure they're the numbers people would come up with. They would feel like this market was down a whole lot more than that. Equity futures stable this morning following 5 days of gains, 2 hours away from the cash open. With your morning movers, here's Danny Berger. Hey, Danny.
Hey, John. The cruise line operators have been so fascinating to listen to because they've defied any of the consumer gloom, and that continues. We just heard earnings from Royal Caribbean. A record quarter for them. They also said April bookings so far are ahead of expectations, and there's no reason to believe why 2025 wouldn't remain on track, defying the other gloom we've heard from companies. Those shares up 4%, their guidance also surprising to the upside. Now, on the complete opposite end of the spectrum, we have GM, those shares down over 2% this morning, scrapping their guidance for the year, at the same time scrapping their $4 billion buyback, saying that they would update the market when they have more clarity. And just in a sign of how unsure things are, they were supposed to hold their earnings analyst call today. They're not even doing that. They're waiting and postponing until Thursday before they speak with the analyst community. The final bit of earnings to round things out with, we also heard from PayPal this morning. Shares down 2%. At first, their results look strong, beat expectations. Shares rose. The CEO said their turnaround remains on track. However, they did not update their guidance. Also said that macro uncertainty is going to play a part, and thus you get the fall in shares about 2%, John.
Danny, thank you. Thank you very much. More from Danny later this morning. Let's turn back to GM. On our radar this morning, General Motors, the latest company to pull earnings guidance. The automaker also putting $4 billion in share buybacks on hold, citing, guess what, tariff uncertainty. Danny's point on the call, I think, is an interesting one. They'll have their own reasons for this, but I think it works perfectly. And I'll tell you why. The call is going to take place after the address from the President of the United States. The address which might reveal some exemptions, some weakening of the tariffs around the autos. And I think that will provide the clarity they need to be able to talk to investors and analysts alike.
And right now, they are in PR mode with respect to President Trump. Mary Barra came out after those exemptions and said, we welcome this. We think that it's wonderful what the president is doing and are looking for something to bring manufacturing back to the United States. How much can they get further exemptions aside from just not paying aluminum and steel tariffs on top of everything else still remains to be a question.
That's why they can't guide. This is incredibly challenging. The situation remains very fluid in Washington, D.C. They were expecting to pay these auto part tariffs starting this weekend. And guess what? It sounds like the administration is going to say, we're going to evaporate those, especially if you're paying an aluminum tariff. We don't want you to be double taxed. The auto industry, though, has had a massive lobbying effort on this administration. I wonder, actually, if we see even more relief.
It's not just GM. We're seeing this across so many different industries this morning. Lisa, we've been through it so many times already. GM, UPS, Pfizer, JetBlue, the list goes on and on.
And it's really important to emphasize, and I want to go back to this, it is very rare for companies to withdraw guidance. This is not a usual occurrence. Even in 2020, it was too quickly moving, the COVID shock, to really engender this type of response from earnings. This is something that we probably haven't seen going back to the financial crisis. And it really raises questions about how to extrapolate out information and earnings in the market.
More earnings coming through this week, of course. Tech earnings very much in focus over Wednesday and Thursday. Tomorrow, Meta and Microsoft. Thursday, Apple and Amazon. Just a quick update on a story we mentioned briefly just then. President Trump is planning to offer some tariff relief for automakers. White House officials saying some levies would be lifted on foreign car parts, and imported autos would see a reprieve from separate steel and aluminum tariffs. Elsewhere, the Treasury Secretary, Scott Bessent, setting a goal of July 4th to pass the president's multi-trillion-dollar tax package. Trump putting increasing pressure on the GOP as the polling doesn't make for good reading over the past week.
No, they're desperate to move on from tariffs, talk about something else, tax cuts for Americans. That would poll definitely well, and certainly the market would welcome that. The issue is the Treasury Secretary is talking about July 4th, Independence Day in the United States, to get this bill done. And then right after that, Majority Thune comes out and says, ooh, that's aspirational, because they know within Congress that this is going to be incredibly challenging to get over the finish line. You have so many issues at play here. It's going to take a long time.
Policies in Washington totally reshaping elections taking place around the world, including Canada. Canada's Liberal Party projected to narrowly win a fourth consecutive election. Bloomberg's David Gura joins us now from Ottawa for more. David, we were talking about it yesterday. This is not the result people were anticipating only a few months ago.
Yeah, so this was a late night that bled into an early morning as we watched the ups and downs of the vote tally and, of course, the resultant reaction in the Forex market, as well as folks reckoned with the fact that Mark Carney is going to have a mandate here as prime minister, a fourth term for the Liberals, but it's still unclear how big that mandate is going to be. 4 seats shy of having a majority, which would give him a lot of power to advance his legislative agenda going forward here. And you rightly bring up the fact that just a few months ago, this outcome would have been all but inconceivable. Justin Trudeau in the tail end of his term as prime minister, the Liberals not doing well among the electorate broadly, a lot of dissatisfaction about the economy, but a couple of things changed, and they're not unrelated here. The first, that Mark Carney won that Liberal leadership election, and people had a lot of faith in somebody who is a technocrat by career, somebody who ran 2 central banks and said that he was quite proudly not a politician and recognized the gravity of this moment. The moment is the second thing that I want to emphasize here, and that is Donald Trump's return to the White House and the messaging that we heard from him about the long-standing economic and trading relationship with the United States and Canada, and the security relationship as well. On top of that, the attacks that he made on this country's sovereignty. That was very resonant with the electorate in this country broadly. It was something that the Liberals capitalized on as they campaigned, and the Conservative Party as well. And so what voters were thinking about yesterday as they went to the polls across this country is, who did they want to represent them at a meeting in the White House between the Prime Minister and President Trump when that takes place? And Mark Carney said when he became Prime Minister just a few weeks ago, that conversation wasn't going to begin in earnest until the election that we had yesterday was finished. So in his remarks just a few hours ago, he again emphasized the fact that he's going to bring a strong message to the President of the United States, talk about that trade relationship, what's on the table and what's not. And that issue of sovereignty that I mentioned, it is not going to be on the table. He is emphatic that he doesn't think that President Trump has been joking about Canada becoming the 51st state, and this is a non-negotiable item for him. Canada will not negotiate on any terms of that going forward, John.
David, when it comes to the Conservative Party, they were ahead 20 points just a few months ago, and the leader of that party actually lost his seat. What is the future for Pierre Poilievre?
This is an extraordinary development. It became clear as the night wore on. He is proudly from the western part of this country, but his riding, his district is about 30 or 45 minutes from here in Ontario. He lost to the Liberal candidate. Now, that throws a lot into uncertainty. He could continue as the leader of that party, and he enjoys a lot of popularity in that party broadly. He's managed to unite it. Can't, of course, be the opposition leader in Parliament not having a seat. So, if you look at paths forward here, looking at history as a guide, the Conservative Party has ousted those who haven't held their seats in leadership. If he hangs on to it, there could be sort of a by-election in the months ahead. He could convince a Conservative member of Parliament to step aside and take that seat. But what I'll stress here, Annmarie, is that would take time. It would take time to call that election and have that election. And what we've learned over the last few months, over the first 100 days of Donald Trump's second term, is there's a great urgency to this moment. And any time waiting for something like that to happen is going to be a handicap, yes, to Pierre Poilievre, but to this party as well. And so we'll have to see what happens here in the coming days and weeks.
David, thank you for the update. David Gura there of Bloomberg. North of the border, south of the border, policy in Washington has completely upended this election in ways that we didn't foresee only a few months ago. Threats and/or jokes to sovereignty, additional tariffs have completely shaken things up. And we've been saying over the past few months, I don't really understand it. Why the president had such little interest in the outcome of this election? Wouldn't it have made sense to have a North American powerhouse, a more pragmatic, conservative approach to energy? Wouldn't that have worked for both sides, both for Canada and the US under President Trump?
It seems that President Trump declared victory when it came to Canada when he ousted 3-term Trudeau, who obviously there's a tremendous amount of friction between those two and that relationship. And it's almost like because he went too far in this maximalist aggressive approach, he made the Liberal Party great again. And Mark Carney swooped in, coming from out of nowhere basically, swooped in and won this, even though the Conservatives were 20 points ahead when Trump was inaugurated in January.
Unbelievable turnaround, a big shake-up to Canadian politics off the back of policies in Washington. Let's turn to a busy week of data ahead and a busy week for Washington as well. The Fed's next rate decision just a week away. Collin Martin of Charles Schwab writing, while soft data has been concerning, the hard data has held up well. If this week's data disappoints, the Fed won't necessarily react. Collin joins us now for more. Collin, good morning.
Good morning.
Torsten Slok, Apollo. Don't know if you saw this. I'm going to share it with you now. The survey week for employment this week was the week after Liberation Day tariffs were announced. He goes on to say the consensus expects 130K. There are significant risks the number is going to be lower, perhaps even negative. What's your reaction to that?
It'd be pretty disappointing. I mean, when we look at the labor market outlook, there's all these thoughts and concerns about what could happen as the tariffs are put in place. over the next few months. And there isn't too much concern in the here and now, opposite, aside from what Slock just put out. I mean, I think the consensus estimate is 165,000, something like that. If we were to see a slowdown here in April, I don't think that would change the Fed's calculus for next week. We kind of heard that from a lot of Fed officials in terms of no move in May, maybe it gets pulled up to June. I think it'd be bad for the markets, though. If we got that negative reading this early, this quickly, I think that'd be a pretty bad outcome.
When you say the markets, you're talking risk assets in particular. And what we have seen so far is a real divergence between the front end of the yield curve, which has really signaled a great more pain than certainly risk assets, whether it's credit instruments or whether it's equity ones. Do you think that divergence needs to close to more weakness on the risk side of things? Or do you think that people are pricing in an overly large response by the Federal Reserve?
I don't think they are. If you look at the 10-year Treasury, for example, I mean, that's been hovering in that 4.2 to 4.5 range. I think a lot of that comes down to potential confidence, dollar concerns, things like that. If you look at the Fed funds futures market, they have been pricing in relatively aggressive cuts. We somewhat disagree with that. We don't think we're going to see that slow down as quickly as a 3 or 4 rate cut outcome suggests. But it does come down to the labor market. If we see that weakening, we think the Fed over time will react. We're seeing Powell kind of pivot away a little bit. I think a week and a half ago, he mentioned maybe we'll focus on the inflation mandate more than the labor market mandate. That seems to be the minority right now based on concerns and comments we've heard from other Fed officials.
This is a fascinating moment where Lotfi Karui of Goldman Sachs yesterday came on the show and said that he actually prefers credit risk to sovereign risk right now. And it's talking about removing from some of the volatility that you're seeing in Treasury markets to really go with corporations that are telling you we have no clue, that are one after another saying we can't give you any forward guidance. Can you reconcile that? Do you agree with that?
Somewhat, but I guess it depends how much credit risk we're talking about. We're still a little bit cautious on, the very low rated parts of the market. I mean, junk in general, we're worried that spreads can blow out if we get this prolonged trade war. Investment grade, we're still pretty comfortable taking that risk. So whether it's credit on the corporate side, whether it's municipal credit risk, we're okay there because the hard data leading up to now was generally okay. Corporations are in pretty solid footing, especially IG rated. We're looking at really strong balance sheets, plenty of liquid assets. If profits slow down, I think that might be more of a stock market issue. That's an earnings issue, not a balance sheet issue. We think they have really strong balance sheets right now. Again, IG issuers, they've pushed back that maturity wall a little bit. So IG we're okay with, but we're not really taking low credit risk right now.
This is a really tough time to be an investor, I have to say. I can just begin to imagine. There's so many different themes that are kind of overlaid. You've got this question of credit versus sovereign risk, and then you've got a question of just international appetite for U.S. dollar-denominated assets. And that has been one of the biggest shifts over the past few weeks, is that's really been called into question. How much have you changed your allocation to shift away from U.S. dollar-denominated assets, just a touch on the margins, to immunize yourself from that type of narrative that does seem to be becoming entrenched in certain pockets?
I could say we're talking about it a lot more with our clients than we were a few months ago and over the past few years. When we look at international markets at Schwab, it's not really a big aspect of what we look at. I think most U.S. investors from a bond standpoint are probably underallocated to international debt. With the dollar being as strong as it's been over the past few years, there hasn't been as much of a case because you have that yield disadvantage when you consider other global developed markets. If the outlook is for the dollar to weaken a little bit from here, then the case can be made to shift a little bit to international assets. We're not saying go nuts, we're not saying go overweight, but it probably makes sense, especially when you talk about the idea of a loss of confidence or sovereign risk. You don't hear about those concerns with some of the higher rated issuers in, say, Europe, for example. So I think it's a decent option, but really just for investors who are probably underallocated right now versus, hey, take all your money out of the U.S. and go into Europe, for example.
You said you're talking to your clients about this. Are they nervous about U.S. losing something like reserve status?
Yes. Full stop. I mean, that's over the past few weeks we've done.
Have you ever heard this before?
We get it a lot. It's a question that it always lingers, especially when you have the idea of rising debts, rising deficits. There's no shortage of concerns about the outlook for the dollar and how investors should be positioned. But over the past few weeks, especially since so-called Liberation Day, the client events and requests for communications have been, through the roof. No surprise. And that's a major concern. The question is, what's going on with Treasury, with foreigners potentially selling our debt? What's the outlook for the dollar? we try not to be too alarmist about it. We don't think the dollar is going to lose its reserve currency status overnight. I think there could be a risk over the long run if the goal here by the Trump administration is to reduce those trade deficits. Then maybe that means we have less of a capital account surplus, and it means foreigners over time don't need to hold as many dollars. It's a very long-term view, though. So we're trying not to be alarmist. Obviously, there's concerns out there, but we're not saying you need to get out of the dollar or dollar-denominated assets right now.
It's not something that happens overnight. It's something that happens gradually. And we have started to see this take place. The dollar's started to weaken. Gold started to appreciate. That's been a story for the last couple of years now. And some other people would also point to the steeper curves we've seen as well. Less of a willingness to hold the long bond, particularly in moments of stress in equity markets. You're not even seeing subtle signs of this starting to accumulate.
What do you mean by starting to accumulate? With foreign investors and nervousness about long-term debt?
Nervousness about holding U.S. assets, particularly at times of stress.
You know, I don't know if it's so much a nervousness. I think it's just a gradual shift away. Hey, there's a lot going on right now, and if you're a foreign investor, and it seems like it might be private investors as opposed to central banks, obviously these are negative headlines if you're a foreigner. Just the idea of maybe I don't want to hold that asset right now. But John, you hit the nail on the head. It's a long-term potential shift. This takes years for something like this to happen. And it's not our outlook right now, mainly because where else can you go? I mean, the dollar is still the most held asset, the most traded asset. So it's not something that we're worried about right now.
And if you've been away for a while and came back and saw DXY at 99, you probably wouldn't freak out. That's for sure. Good to see you, Collin. Appreciate it, as always. Collin Martin there of Charles Schwab on the latest. The latest in the equity market, equity futures at the moment, just about unchanged. Nothing unchanged about some of the corporate earnings and guidance we've had so far this morning. More on that in just a moment. With an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hackett. Say, Yahira.
Hi, John. Coca-Cola shares are up 1.2% in the pre-market after the beverage giant beat Wall Street expectations on first quarter profit. The figures show that price-conscious consumers continue to purchase the company's drinks despite worsening sentiment. Plus, in the earnings statement, Coca-Cola said it expects tariff impacts to be manageable. Meanwhile, UPS is planning to cut 20,000 jobs this year as it dramatically reduces shipments for its largest customer, Amazon. The company said it will close 73 leased and owned buildings by the end of June and may identify more facilities for closure. The announcement coming as UPS reported solid first quarter results, but pulled its 2025 guidance. And OpenAI now lets users shop for products within ChatGPT. Users can compare products and click a link within the platform to make a purchase on an external website. OpenAI said the company won't collect affiliate revenue for purchases made via its chatbot. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in the next hour. An update from HSBC. New price target on the S&P 500 just dropping 5,600. Down from 6,700. That's a catch down from HSBC. Up next on the programme, earnings from big tech.
Technology is the sector which is most vulnerable to the various tensions. We'd be a little bit sceptical at this point that there isn't further downside to go for these tech firms. They do sit in the eye of the storm with regards to tariffs.
The calendar absolutely stacked over the next 2 days for mega cap tech. We'll get a view from Mandeep Singh of Bloomberg Intelligence in just a moment. That's next. This is Bloomberg. Five-day winning streak on the S&P 500, the longest daily winning run going back to November. This morning we stalled just a touch. We're negative by not even 0.1% on the S&P, down by 0.13 on the Nasdaq 100. The Nasdaq in focus under surveillance this morning. Earnings from big tech.
Technology is the sector which is most vulnerable to the various tensions. Now, we are hearing from investors that they're looking to maybe dip their toe in the tech trade again, given the very big re-rating that we've already seen. But I guess that we'd be a little bit sceptical at this point that there isn't further downside to go for these tech firms. They do sit in the eye of the storm with regards to tariffs.
So here's the latest. Meta, Microsoft, Amazon and Apple delivering high-stakes earnings this week in a volatile trade environment. Bloomberg's Mandeep Singh joined us now for more. Mandeep, good morning.
Morning.
We've had Alphabet already. What did we learn from them about what's to come this week?
That companies with low China revenue exposure and low exposure on the cost side, the cost structure, will end up doing well. That's why they had a nice beat on the earnings despite the competitive pressure from ChatGPT. And look, they called out the de minimis rule, companies shipping their products directly from China. The end of that will have an impact on their ad revenue, but it's still manageable. So to me, Meta will be similar. Microsoft will have minimal impact. The big ones are the ones that have high revenue exposure, Apple, and the cost side is also exposed to China. Tesla, we already heard from them, but NVIDIA as well, they can't sell their H20s anymore. So that's where, the numbers are not easy anymore to beat, and you won't see any upward revisions. The catalysts are just missing.
That kind of being able to withstand any type of tariff volatility is also paired with a reaffirmation, at least from Alphabet, in their capital expenditures. How much do you expect that to be the story? That the loss of AI spend and maybe the over-exuberance, maybe it wasn't that over-exuberant. Maybe we just lost a little bit too much faith in the story.
I mean, I go back to, 2022 when the end of the low interest rates came. These companies were very aggressive with regards to cutting their OPEX, the headcount reductions they had. So if they saw, things are really slowing down, they would rationalize the CapEx. It's bound to happen. The question is, Apple obviously is the one that's most exposed. They're not one of the biggest spenders on CapEx. Google is, and they reaffirmed their CapEx numbers for the whole year. I think Microsoft is going to do the same. So from that perspective, the big hyperscalers are still going with that CapEx. Clearly, if Apple says they have already announced $500 billion in investment here, if they're going big on CapEx this year within the US, that's going to be another huge tailwind for AI infrastructure. So it's not very clear if these companies are looking to pare back their CapEx, but we know back in 2022, they did rationalize the OPEX. So that's the framework. If they see a longer downturn, they will pare back on CapEx.
The Treasury Secretary said to me that the NASDAQ earlier this year, when it took a nosedive, had a Mag 7 problem, not a MAGA problem. But everything you're talking about is companies having to de-risk because of policy. How much are tech companies looking to Washington because of policies that they actually do have a MAGA problem?
I mean, look, these companies have over 50% of their revenues coming from international locations. So, the reason why they are so big is because, they have such big international exposure, and tariffs plays directly into that. I mean, whatever we kind of witness with the reciprocal tariffs and then the changing stuff, all that has an impact with regards to what happens to their international revenue. So in the end, these companies are pretty much exposed to the international revenue exposure.
Just quickly, how's Gemini doing?
Well, I like the Gemini Live, and the reason I say that is I can't use it on my iPhone yet, but if you have, an Android phone, the Live feature, you can pretty much interact with it like, a virtual assistant, and it's amazing, It doesn't waste any time in terms of answering a question.
Do you know what I've been doing with ChatGPT? Monitoring blood test results, then capturing a menu and asking it what I should eat. Just like that. It's amazing. It's fantastic. And sometimes when I'm sitting down for a meal, I can't choose. I'm really tired. And it's choosing for me. And it's choosing the right thing. Okay. It's brilliant.
All I could say is that reveals so much about you, John.
You should try it.
On so many levels.
You should try it. Seriously.
Your nutrition.
I bet you a lot of people at home, next time you go to a restaurant, snap a photo of the menu and ask you to choose and give it some requirements and see what happens. Mandeep, it's good to see you. Mandeep Singh of Bloomberg Intelligence. If you have health requirements, dietary stuff, don't blame me for that. Speak to your doctor. All right? From New York City this morning, good morning.
The market is just hoping that we've got the worst of the tariff story behind us.
The longer this goes on, the more uncertainty pervades, the less likely, the upside becomes a reality.
It's no longer uncertainty. It's not what we don't know, but unpredictability of how things behave or things react.
I just caution people, things may have to go down a little bit more before they go up.
Things can get a little bit sloppy over the next couple of quarters.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The opening about 90 minutes away. Equity futures on the S&P 500 barely negative, down by not even 0.1%, following 5 days of gains on the S&P 500. A 5-day winning run for stocks, a 5-day winning run for bonds. Yields lower over the previous 5 days. Yields now on a 10-year, 4.2274. And a man who will be happy with that is a man who will speak in about 30 minutes' time. The Treasury Secretary, Scott Bessent, in a press briefing from the White House at 8:30 Eastern Time, just before we get some data a little bit later.
Yeah, we're going to get some data later with respect to jobs and the job openings and people's confidence that they can quit their jobs. A question about whether they really welcome the 5-day rally in treasuries, given that it has been this sort of knee-jerk move in accompaniment with the stock market. Do you want to see a reversion back to that traditional inverted response between stocks and bonds? In other words, make sure it's not a dollar call before really breathing life into this idea that we're actually seeing some sort of sustainable rally.
Away from the equity market, I think pressure still building. Away from the bond market, I think pressure still building. It's coming from the lack of corporate guidance, the threat of cost cuts, the potential for higher unemployment, and empty shelves.
That's right. And potentially the Treasury Secretary is going to try to offer some guidance, or the reporters will be asking him for some guidance. I think he's going to strike an optimistic tone when it comes to trade deals potentially being done in this window of a 90-day reprieve with trading partners, barring China. That's the big question mark. And what did the Treasury Secretary say over the weekend? He wasn't sure if President Trump spoke to Xi Jinping. The status of those negotiations, that is what the market wants in terms of clarity.
This is what the market wants to hear throughout today. Deals, exemptions, and tax cuts. They want to hear that repeatedly by the president later on this evening in Michigan. They want to hear it from the Treasury Secretary in 28 minutes.
Yeah, take some of the pain outside of the out of the tariffs and then move towards some of the more constructive pro-growth policies. If he can't do that, there is a real question about how much momentum is going to shift away from him, both with polls, but also with respect to economic momentum. Right now, it seems like there is some sort of Trump put. It just really is unclear exactly where that is.
Stocks right now negative by about 0.1% on the S&P. Coming up this hour, we'll catch up with Savita Subramanian of Bank of America, with stocks on their longest winning streak since November. Daniel Roeska of Bernstein on the latest earnings from GM, and Kathy Bostjancic of Nationwide Mutual. Looking ahead to this week's payrolls report, we begin this hour with stocks attempting to build on a 5-day winning streak. Savita Subramanian of Bank of America writing, "The only thing to fear is fear itself. Folks are worried about a recession, so they are acting recessionary. Speed in achieving policy clarity is of the essence." Savita joins us now for more. Savita, good morning. It's good to see you.
Good morning. Great to see you.
A lot of cuts to outlooks. We're seeing suspensions of guidance repeatedly across the board from corporate America this morning. What does that mean for you and the team?
Yeah, well, I mean, it's not great. It's definitely not good. We're seeing the revision ratio, just a number of cuts to number of raises to earnings, approaching all-time lows. Guidance is being suspended. That's a hit. I mean, we saw the same thing during COVID, probably more so during COVID, because there was a much higher level of uncertainty. And what we found was the companies that continued to guide actually traded at the widest premium to the non-guiders or the suspenders that we've seen. So I think right now people want transparency. Investors want to know. So that's one thing we're watching. I think what's interesting is that in the last week, we've heard more companies talk about mitigation tactics for tariffs than we did in prior weeks. So I think that what we're in right now is the environment where corporates are doing what they always do, which is adapt, figure out where they can, kind of change things around the edges. And on top of that, we're seeing kind of a deferral of big decisions. So it almost feels like we're in this phase where there's no hiring, but no firing. There's, no new capital committed to projects, but projects aren't necessarily being canceled. And I think that's both good and bad. I mean, this pause, the longer it lasts, the worse it gets for the economy. But at least we're not seeing just this sort of reactive firing, canceling, kind of a downdraft in activity.
This is important for the data that comes on Friday.
Exactly.
When you say adapt, then, if they're not firing, how are they adapting? What are they doing?
So what they're doing is they're sort of shifting supply chain. They're thinking about more manufacturing in the U.S. I think that the idea that we've seen this movie before back in 2018, especially with respect to China, gives companies a little bit more confidence that they know how to negotiate this. So I think that's a positive. What's interesting, though, is that you're hearing more weakness around consumer. and even in consumer staples. So if you think you can hide in the food stocks and the defense, not necessarily working this time. And I think that's also noteworthy. I will tell you, I mean, everything we're looking at really points us in one direction, which is large cap value. And I feel like it's almost this kind of unassailable theme in an environment where the risks are, potentially higher yields, and we can talk about that. Potentially higher inflation, because what we're seeing right now on the table from a policy standpoint is mostly inflationary. And in that environment, you really don't want to be in bonds, you want to be in dividends. Russell 1000 value companies have a much higher tether to non-discretionary spend, either services or goods. Think about it. I mean, if we're in an environment where we're, cutting back, we're still going to pay insurance, we're still going to pay utilities, heating, et cetera. So I think those types of areas of the market should hold up quite well. And the value index, the large cap value index, has kind of consistently outperformed the growth index this year. So I think that's where you really want to be to sort of cover yourself, as opposed to just going pure defensive, kind of the old school defense playbook.
Yeah, to your point, some of the consumer staples, Kraft Heinz came out and cited worsening consumer sentiment and cut their forecast. Evidently, Oscar Mayer sausages, as well as your Heinz ketchup, but not necessarily moving off the shelves as quickly as in the past. You said you wanted to talk about
hot dogs.
Yeah, well, I mean, maybe that's something else. Maybe that's John's hack in terms of healthcare.
ChatGPT,
exactly. Maybe if you check your blood and then you check that Oscar. Anyway, let's move on. You talk about yields. Let's go there. You have a very non-consensus call on what U.S. equity markets are implying about where Treasury yields could go.
Yeah,
7%, really?
7%. So this is the analysis. We said, okay, equities and the corporate sector is actually quite unlevered and unusually healthy when it comes to leverage, because all that leverage sits on government balance sheets. So if you look at the leverage ratio between corporates and the government, complete opposites. And if you apply the math, so what we found is that investors will pay a higher multiple if leverage risk is lower. If you apply that math to where bond yields are, where the U.S. government is, it spits out yields of around 7%. It's a much higher level of return that investors need to see in an environment where leverage is so high.
This is following the logic that the math is the same for U.S. sovereign risk
I mean, it's
as
back
in corporations.
Of the envelope.
Well, it's back of the envelope, but this raises this real question, which is if there is a credit risk component to U.S. sovereign debt, how much does that impede the equity story in the United States, given that a lot of guests who come on this show say once 10-year Treasury yields hit 5%, forget about it. You're going to see some losses in equities.
Yeah, I don't necessarily think so. I mean, let's say we're kind of becoming more like an emerging market. Sometimes emerging market equities do really well, especially when they're unlevered and there's potential for growth. And I think that's where we are today. So if you look past tariffs and you think about what the administration is trying to do, we're trying to get America manufacturing again. We're already seeing the seeds sown for that story over the last 4 to 8 years. So I think that the idea that stocks have to implode if yields hit 5% is completely false. In fact, we've looked at this a lot of different ways. I mean, think about it. Yields right now are not unusually high. 7% sounds really high, but it's, we've been there. We've been higher in the past, and stocks have done okay, especially dividend yielding stocks. So I think this is an environment where we have to kind of recalibrate to what's actually going on. The U.S. government debt levels are at, off the grid. We've never seen this before. We're seeing a closed economy. We're seeing signs of a closed economy. We're seeing signs of inflation. We want to see growth in the U.S. That's what the policymakers are trying to get. And all of that is likely to push up bond yields on the long end.
But
yeah,
right. The administration, though, is targeting lower yields. If it hits 7%, does that mean they failed?
I don't know if it's failing. I mean, I think it's just sort of, we're all anchoring to super low rates over the last 20, 30 years, and they've been falling the entire time. But think about where we are now. I mean, rate cycles last for decades. We were in a multi-decade period where interest rates were falling. So I just think we should sort of gear ourselves for the idea that interest rates rising even from here is not necessarily anathema for stocks. From a policy perspective, I mean, nobody's calling me about, if rates move higher, have we failed? But I think that the idea is if rates move higher, but growth is accompanying that rate move, that's not a failure. It's actually kind of a more normal boom time economy. And I just think we're so not used to that because we haven't seen that in such a long time.
Why they're higher, though, is important. Is it going to be the boom time economy that takes rates higher, or is it going to be something else?
I think it's a whole bunch of things. The good case is positive growth. The bad case is sovereign risk. It's also a lack of demand for U.S. treasuries because the buyers, foreign buyers have left the building. The Fed used to buy treasuries. I mean, one could argue that if we get to 5% on rates, the Fed will step back in and start buying. But I think even there, we've got an environment where, again, going back over time, we're just all looking at the last 10 to 20 years, and we're thinking that 5% seems unsustainable. Companies aren't geared for it. Companies are actually very geared for a higher rate environment. They've paid down debt. They've locked in very low fixed rate obligations. Consumer balance sheets are pristine. I mean, for the most part, you're seeing some fraying around the edges, but when you think about what just happened, the government gave the private sector a whole bunch of money.
True.
Right? So what do you want to buy, the government or the private sector?
But when I hear you, Savita, I hear you talking about the potential for earnings. I don't hear you talking about the potential for what people will pay for those earnings. And when you talk about higher sovereign risk, when I start to think about that, when I start to think about what could happen to the sovereign, that makes me think that people won't be willing to pay for earnings in the same way they were, particularly foreign investors who have built up an incredible long on dollar assets over the last decade. What kind of multiple are you putting on that very optimistic outlook?
It's tricky because I think the S&P today is a very different animal than it's been historically. So saying a 15 multiple, which is the long-term average, you just slap that on and that's what you get. I don't think that's fair. I think that's overly punitive because when you look at the market today, it's, higher margin industries with a lot of potential to become even higher when you think about old economy sectors that can use a lot of this automation and tools and, little AI sprinkled in to get more asset light and, kind of improve margins and improve earnings variability. So I think a multiple of 20 seems completely reasonable. In fact, we ran this analysis where we looked at the S&P 500 versus other global benchmarks. Granted, the S&P is trading in the stratosphere. Everything else is super cheap. Now, if you adjust for sector mix, if you adjust for earnings volatility, leverage, consumer aspects, you actually come to a conclusion that the S&P isn't that expensive relative to these other benchmarks. So I think by just sort of painting this historical average, everything has to trade at the same level, I think we're sort of oversimplifying really important details about U.S. corporates.
A big dose of optimism this morning from Savita Subramanian of Bank of America. Savita, thank you.
Thank you.
A lot to think about.
Yeah, optimism for who? Maybe for the equity investors, not for Scott Bessent. The idea of 7% yields would be a real problem for the federal deficit as well as expenditures, given that a fifth of all Treasury outstandings are in T-bills. That means that they will be at 7%.
And there's one man who owns that, right?
Yeah.
Or owns a lot of it, anyway. Equity futures on the S&P just about unchanged, with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Hims and Hers shares are soaring 30% in the pre-market on reports that the telehealth company is partnering with Novo Nordisk to offer its weight loss drug Wegovy at a reduced price. The partnership aims to fill the gap in access to affordable weight loss treatments at a time when companies are no longer able to sell compounded versions and demand remains high. Meanwhile, UPS shares are also rising 1.4% in the pre-market after the company reported first quarter earnings that beat estimates. It also said it plans to cut 20,000 jobs this year as it reduces shipments for Amazon to focus on shipping higher yielding packages. Like others, UPS pulled its 2025 financial guidance due to macroeconomic uncertainty. And S&P Global Ratings says it's no longer considering cutting Boeing's debt to junk status. It says Boeing appears on track to recover from strike-driven production halts last year and persistent quality issues. S&P currently assigns Boeing a BBB- rating, one step above junk status. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this morning. Up next on the programme, the morning calls. Plus, Daniel Roeska of Bernstein after GM joins a chorus of companies pulling full-year guidance from New York. This is Bloomberg. The opening about 1 hour and 12 minutes away. Equity futures into that negative by 0.1%. That's some of the price action for you. Let's get to some morning calls. First up, UBS kind of gets price target on Amazon to 253, anticipating tariff-driven demand destruction. The stock is up by 0.16%. Your second call from Morgan Stanley, raising its price target on Apple to 235, expecting earnings to beat expectations on strong product pull forward. The stock is positive by 0.06%. And your third and final call from RBC, reiterating its outperform rating on GM, saying it benefited from pre-buying ahead of tariffs. That stock is negative this morning by 1%. Let's stick with GM. Daniel Roeska of Bernstein reiterating his outperform rating or underperform rating on the stock, writing, quote, GM seems to have been unaware of the Trump administration's plans and or timeline. This worries us immensely. Daniel joins us now for more. Daniel, good morning. Good to see you.
Good morning. Good seeing you.
What was it about the way this was released that was different to other quarters?
In the sequence, you clearly had a pre-press briefing, as is customary, yesterday afternoon. And after that, the Trump or administration's announcement saying there will be some sort of reprieve to tariffs followed. And then GM decided to not talk to investors this morning. So that's a pretty specific timeline. And it just shows that apparently GM had no knowledge that this would happen in terms of the tariff relief today or yesterday evening.
So we're all flying blind. What's your base case now? What's your working assumption for any of this?
I think if you look at it, and I'm surprised a little bit at the street and the valuation of the companies at this point, what Lutnick's announcement yesterday confirmed is that vehicle tariffs are going to stay in place, 25%. Parts tariffs are coming starting on May 3rd. And the addition is we're going to have some reprieve for people who manufacture in the U.S. The market has been discounting a couple of months of vehicle tariffs, but no parts tariffs. And so for us, this is still clearly from where the stocks are right now, a negative signal.
How much, though, do you get comfort from the fact that it appears, based on the timeline, and I realize this is so speculative and reading tea leaves and all of that, but that's where we are, that there is some room for negotiation and that they truly believe that at a time where President Trump is going to Detroit to really celebrate his 100 days in office?
Look, there definitely have been conversations going on. I'm pretty sure there still are conversations going on. What's worrying to me is that the ideas that have been floated over the past couple of weeks, kind of excluding some of the bigger components or the smaller components, expanding the U.S. content rule to mean it's actually U.S., Mexico, and Canada. And now we get kind of this new announcement. So I'm going to say if they do all of that, so if they limit the parts, if they expand the U.S. content to include Mexico and Canada, and if they give some reprieve, that will be good news. But you really have to do a broad-based relief to really give any upside to the stocks to where they are now.
After the announcement from the White House, the CEOs from Ford and General Motors came out and welcomed this and said that they welcome bringing jobs back to the United States, et cetera. You're smiling. They're trying to negotiate, have a PR move ahead of these negotiations. At what point will it be beneficial, if ever, for these companies? Or is there no bull case at all in your mind if these tariffs in some shape of how they are right now continue?
So look, I think one, you have to stipulate that yes, these tariffs will incrementally move manufacturing to the U.S. Not in big parts. I don't think anybody will shut down factories in Mexico and move, but incrementally there will be more manufacturing coming in. I think the bull case some people are hoping for is that external OEMs, so OEMs from China like Mitsubishi, for example, who don't make a single car in the U.S., that they pull back from the U.S. market. And that is maybe where we have a different view. If you're Mitsubishi, U.S. is a third, maybe half of your earnings. You've built 30 years of supplier, parts networks, dealerships in the U.S. Are you not going to sell a single car in the U.S. the coming years? The answer is most likely no. You cannot leave the market. And so while we're moving incremental production to the U.S., we will not see market exits. And so there really is two things. One, yes, more production in the U.S. means higher prices for cars. More cost for the OEMs means higher prices for cars, and higher prices for cars means lower demand.
What about the upside to all the tariff negotiations? The fact that maybe American autos for the first time can really make a push in Japan if they're going to potentially loosen up some of their safety issues that they have. This is something I know the administration is really trying to get over the finish line. Is there an upside to American companies outside of America?
The tariffs to import cars into Japan are zero from the U.S. Yes, there are some different homologation requirements to make cars safe in Japan. For example, also the Tesla Cybertruck wouldn't be road legal in Europe. It has too many sharp corners. Yes, possibly, but I don't think there is a significant upside. If you put these cars side by side, manufacturing in the U.S. is just expensive. The cars are, I'm going to say, on par to not that great compared to the content in those other markets. It's really about the innovation and the capabilities of U.S. companies, and I do not think that tariffs really help that.
When I spoke to the president a few weeks ago on Air Force One, I was traveling with him in the press pool. He had said that day, I got off the phone with an auto executive, and an executive wouldn't say who it was. There are conversations on every level, a lot of conversations as well with the Chief of Staff, Susie Wiles. Is there a sense that you think the autos really know what the administration wants to see for a massive reprieve?
I don't have any more information than you at that point, so it's kind of guessing at that and saying the actions of the administration have been very incoherent when looking at it from an autos perspective. If I am an autos expert and I look at what is happening, it does not make any sense to me. There are a million different ways to do this. This is probably one of the worst ways. And so putting more reprieves into it, that's great, but really putting cost on cars will make prices go up, will weigh on the U.S. consumer, and will lower volumes. And I think that is the bigger portion that people shouldn't lose sight of, that whatever this is, it's more cost on cars, that's higher prices, that's lower volumes.
You mentioned Tesla. It's not a company that falls under your coverage at the moment, but perhaps we can speak about it in general terms. I remember a note that came from you that Tesla wins, Detroit bleeds. Is that still the case? Is that still your assessment?
Yes, because Tesla manufactures all of its cars in the U.S., and even their parts that they use to manufacture the cars are overwhelmingly domestic. And so, I mean, if I'm the administration, I think the policy goal to say, look, we want to be the U.S. content, we want to have that as high as possible in those cars, definitely. I think a big question on Tesla is where all the batteries are coming from, and what about the China and South Korea tariffs, and how does that factor in? But they do have domestic battery capabilities. But yes, still Tesla is least exposed to the tariff headwind among all the OEMs.
Daniel, appreciate your time. Thanks for dropping by. Daniel Roeska there of Bernstein on the tariff situation. We're all looking for clarity. Maybe we'll get it in just a moment. We're 5 minutes away from a press briefing at the White House where we're set to hear from the Treasury Secretary Scott Bessent alongside the Press Secretary Caroline Leavitt.
Absolutely. This is going to be one of the key questions, especially when it comes to where they are with these trade negotiations and the reciprocal tariffs and the sectoral tariffs. Remember, this is just autos. We're still waiting for pharma tariffs to come down the pipe and semiconductor.
And all the tax cuts, Lisa, that are still to come later this year. Yeah. Independence Day, July 4th.
Yeah, how much can people look to the sweeteners? That candy, remember we ate our vegetables first, which, by the way, you should always eat first and then last too, because they're great. But, when are we going to get the stuff that, maybe your algorithm won't like?
It's a pretty aggressive timeline, let's put it that way. Up next on the programme, a press briefing with the Treasury Secretary Scott Bessent, plus reaction from Kathy Bostjancic of Nationwide. From New York, this is Bloomberg. The opening bell about 60 minutes away and seconds away from a press briefing at the White House with the Treasury Secretary alongside the Press Secretary. When the Treasury Secretary starts to speak, Scott Bessent will take some of those comments for you right here now live on Bloomberg TV. Equity futures on the S&P negative by 0.1%. On the Nasdaq 100, we're down by 0.2%. Let's get you prepared for the opening bell with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. One of the biggest movers this morning was UPS, but it started to ease back on some of the gains. It's up now less than 1%, scrapping its full-year guidance, specifically citing macro uncertainty. It's also undergoing a 20,000 cut of employees and try to right-size as they're no longer taking as many Amazon shipments. Also on the move this conversation, we're just having a conversation about this, is GM. The car maker this morning also scrapping their full-year guidance, saying that they would try to update the market once they have more certainty. Shares are down by 1/3%, also getting rid of their $4 billion buyback. Also postponing their their analyst call. It will no longer happen today. It will indeed now happen on Thursday. Finally, away from earnings, Hims, the telehealth medicine company, surging in the pre-market trade, up some 30%. Novo Nordisk announced that it's going to be working with telehealth providers, specifically Hims and Hers is one of them, also Ro, also LiveMD, in order to supply them with Wegovy and cheaper options for consumers. Of these telehealth medicines had been selling compounds. The FDA has basically told them to stop because the shortages have ended, so that sending shares much higher this morning, John.
Danny, thank you. 3 of the names to look for going into the opening bell a little bit later. Lots of earnings coming up over the next 48 hours or so. You'll hear from Big Tech on Wednesday and on Thursday. Some economic data later this morning as well, and some data just crossing the Bloomberg. With the latest, here's Mike McKee. Good morning, Mike.
Good morning, John. You want to pull ahead effect to the president's tariffs? You got it in the March trade report. March trade gap widens to a record $162 billion. The forecast was for $145 billion. Now, most of this came in consumer goods. Imports of consumer goods up 27.5% on the month. That's a crazy number. Imports overall were up by 5%. Exports were up by 1.2%. And most of that was cars, as they tried to get cars off the lots and out to customers overseas before the tariffs begin. So that is a major number that will put downward pressure on first quarter GDP. Along with this, we get the wholesale inventories report. They were up 0.5%. Retail inventories, though, fell 0.1%. Now, this is a conundrum for economists because there should be an offset in inventories to all of these imports. But even though we got 27% more imports of consumer goods, retail inventories fell. And nobody quite knows what's going on with that, but it'll be interesting to see how it all plays out tomorrow in GDP.
Mike McKee, thank you, sir. With the latest, more data coming later. Job openings, as Mike pointed out. You'll get payrolls later in the week. Consumer confidence coming later this morning, too, so look out for that as well. In a few seconds' time, we should have a press briefing with the Treasury Secretary. So when that room starts to fill out and the Treasury Secretary walks into the briefing room, we'll take that for you in just a moment. Also looking ahead to more data on Friday, as we say. This is the take from Kathy Bostjancic of Nationwide, writing, "We think the economy added just 120,000 jobs in April." Kathy joins us now to discuss. Kathy, welcome to the programme. 120. Are we at risk of something much, much lower?
Well, good morning, John. Well, yeah, I do think the risks are on the downside, but it's a bit early to look for the real negative numbers in payroll, or the hit from the government layoffs and the hit to healthcare and even the cyclical sectors. I think that's going to be a few months from now, but we certainly have seen businesses just pull in their hiring reins. And given that we do see churn in the labor market every month, the fact that you're just seeing companies paralyzed, right, and not hiring, that does impart a downward bias to the number.
Kathy, are there specifics that you're looking for within, like under the hood of the headline number that's going to be important to see?
Yeah, no, absolutely. One of the main engines of growth in payrolls has really been the healthcare and social assistance sector. Those sectors are very much related and dependent on federal government activity and support. So we think those are areas that will start to see, some softening, and then that means overall non-farm payrolls, start to weaken. Really, if you looked at like kind of what we would call the core cyclical sector, we had already seen the labor market losing some steam, but overall healthcare, education, and even the government sector was boosting the overall headline number.
Kathy, we're going to get a host of other data before that, including the JOLTS information, which includes the quits rate. We'll get some more consumer confidence, as John was just mentioning. I'm just wondering, from your vantage point, as you look forward, how you reconcile the gap that we have seen between the soft data and the hard data. Do you agree with some of the earlier guests on the show who said it's probably a 4 to 6 month lag before you see a similar type of deterioration in the hard data?
Yeah, I would agree with that. I mean, maybe I'd say a little shorter, 3 to 6 months, but by and large, the movement in the soft data has been so pronounced. You really have, be careful shrugging that off. Sometimes it can be a little bit misleading, especially the confidence numbers. But when you spoke about the Conference Board consumer confidence data, what I'm going to zero in on is all the labor market readings. And particularly, I want to see the expectations for more jobs, or, jobs are fewer out there, and looking at the labor differential. That, I think, is meaningful. And also consumers' expectations about income going forward. Usually that survey shows this very like an American attitude, future incomes will be up. What we have seen is some breakdown on that, and people becoming a little more pessimistic about future income. That can obviously influence current consumer spending.
But at the moment, we do see consumers also front-loading, wanting to get ahead of the tariffs. What does this mean for spending at the second half of the year, Kathy?
So the data are very skewed by the tariffs. You were talking about, Mike was talking about the import data. Yes, import is going to drag on GDP, but consumption is going to keep it elevated more than it otherwise would be. So it's very skewed. But that pulling forward means there's just a lot less consumption in the second half of the year, regardless of what happens on the tariff front. Like, even if they're resolved, if you bought an auto or a big ticket item, you're not going to be buying one in the second half of the year. So that's certainly going to be a negative for consumer spending and GDP growth in the second half of the year.
John has brought up this point a lot. If you're going out and you're spending on big ticket items, say a car or some sort of SUV, are you actually nervous about losing your job?
Well, that's a great question. I would say no. I think that, by and large, those are people who are just trying to get ahead of the price increase. I think if you're worried about losing your job, you probably hold on to your current car and just run it as long as you can, or look to the used car market, which that's also going to feel upward pressure, right? And prices, we saw that during COVID. So I think that's a really good point. And even in, our outlook, and I would say the vast majority of others I've seen, it's going to either be a borderline recession, or if we get a recession at this point, most of us thinking mild, that means the unemployment rate goes up to 5%. That's still overall historically pretty good labor market, but it's this uncertainty that is really, I think, killing the economy right now.
Kathy, as we've seen, the chairman of the Federal Reserve has chosen to prioritize anchoring inflation expectations. I just wonder, from your perspective, how you imagine that might shape his approach to next week's meeting.
Yeah, he is going to have to walk a tightrope as many times he does, especially during the press conference. But I don't think he'll back away from that. I know some others have been a little more dovish, right, some Fed officials. But I think he'll maintain this idea that, inflation expectations high. The worst outcome for them is it becomes embedded and becomes more persistent. One of the things I worry about is the rollout of the tariffs. Like, we're still waiting to see if there's going to be additional sectoral tariffs. The longer that process gets elongated, the more inflation shock can be persistent, right? I'd almost rather have all the tariffs at once. I mean, it's not good for the economy. But in terms of inflation, it is really hard to gauge then what's, transitory versus persistent.
Kathy, what's your take on some of the pressure that's come from the president on the chairman of the Federal Reserve? How does that reshape the optics of them trying to ease sometime soon?
I think Chairman Powell would say he ignores that, and they're apolitical, and they're only looking at the data. And I think, by and large, that is the case. I just worry a little bit about the optics for market and investors, how they interpret that. And it could be that, they ease for the right reasons, but the market second guesses that. And that would be bad, right? And then you could have long-term interest rates rising while short-term interest rates are lower because of inflation expectations rising, or an extra term premium embedded on the long end.
Kathy, got to leave it there. Kathy Bostjancic there of Nationwide. Over at the White House, that press briefing just starting with the Press Secretary Caroline Leavitt, with the Treasury Secretary Scott Bessent standing by. Lisa, those comments are about to begin. The focus is going to be on tariff relief, exemptions, deals, and then we start to make a bigger push on taxes.
When can they get to the pro-growth agenda at a time where people are focused on the uncertainty that companies are facing? And can he give some sort of reliable guide in how they are going to get this through before or by July 4th, Independence Day, given all of the dissent that we're seeing in Congress?
Happy first 100 days is what Caroline Leavitt says as she takes the podium. Secretary Bessent today needs to first do two things. One, show that optimism, getting trade deals done with these partners. He's talking about India, he's talking about South Korea. Second, try to push the conversation forward when it comes to taxes. But can this actually get done on the timeline he wants. The Senate Majority Leader, who has to deliver the votes in the Senate, thinks it's aspirational.
Called it aspirational just yesterday. Independence Day, July 4th is the target for all of that. How does he answer the question about where talks are between China and the United States and whether those talks are actually taking place?
Well, he did comment on that over the weekend by not commenting on it and saying that he was not in the room with respect to that call. Nonetheless, it is imperative for him to give some sense of just how that progress is going. He did say that deals were imminent. With who? And how significant would those deals be to ratchet back some of the concerns that we're hearing from corporate America?
When it comes to China, the issue, of course, is who's going to properly blink first. I don't mean exemptions. I don't mean some olive branches, but maybe some gracious language that the president has said about Xi Jinping. Actually, someone coming out and saying we're lowering 145% tariffs to, say, 50 or 60%. And until we get that, can you really have an area for negotiation? Remember, China is waiting for the president to make a point person. Every time I ask the administration, they say there is a point person. It's called Donald Trump.
Look how difficult it is right now for corporate America. General Motors, a perfect example of that, coming out this morning and basically offering very little guidance because they can't, and pushing back their call because they have to. Because later on today, we're expecting some kind of news about exemptions for auto parts for these companies to function without higher costs. And they can't offer any clarity on the future without getting that detail.
And there was a shift where they removed any clarity after hearing about those potential exemptions. GM is not alone when it comes to withdrawing guidance. Just this morning, we also had JetBlue withdrawing their guidance, Pfizer, UPS. It's not just the auto manufacturers. At what point will their pleas have the same sort of power that maybe the Walmart and Targets of the world did just last week?
And Daniel made a great point. This is a reprieve on parts of the tariffs. This Saturday, we're supposed to have the auto parts 25% take hold. What the administration is saying, well, also if you're paying aluminum or you're paying steel tariffs, you don't have to be doubled up. We're not going to double tax you. But since April, there has been a 25% tariff on autos writ large. And this is why the auto industry is struggling and also having a full court press lobbying effort down in Washington to try to get some sort of reprieve. But they want something bigger than what we're seeing right now out of the White House.
You made a good point moments ago, the potential to open markets more elsewhere. How great is that potential in places like Japan?
Well, it's something that's definitely on the agenda, and that's happening with these conversations. What the U.S. wants to see is them to have a more relaxed approach when it comes to some of these safety precautions, safety procedures for U.S. autos to get into the Japanese market. They say it's one of the most protectionist places for U.S. autos to actually sell vehicles. If that's part of a trade deal, that would be something welcome for sure by Detroit.
At the same time, how much does it push companies to really manufacture more locally? We saw actually Coca-Cola come out this morning and reaffirmed guidance and talked about exceeding profitability because they produce a lot of their goods locally. In other words, will it have exactly the effect that people are looking for if the walls are so great that people are just looking to really domesticize all production?
The risk is it takes too much time, and you're already seeing the cracks emerge. The trade between China and the United States breaking down. The view from Torsten Slock of Apollo is that transport and trucking breaks down next, excuse the pun. And after that, the job losses begin. The empty shelves start to appear. This is what he had to say about payrolls on Friday. Payrolls on Friday, the estimate is 130K for the month of April. Let's hope it is around 130K. He says the risk, significant risk, is that it's lower or negative, because the survey week was the week after so-called Liberation Day, that point of maximum uncertainty.
And when you heard about people actually withdrawing financing from venture capital, withdrawing financing for potential projects in the face of what they projected out, it does raise a question, how does this market respond to that? At what point is the lever of Fed rate cuts really not effective anymore? If what this market is really not necessarily pricing in is full-blown recession, is that what starts to get priced in if you do see a truly negative number?
And then what does the Treasury's, the Fed do, the Fed chair do? Jonathan, you brought up a great point just now with Kathy. The fact that the president's put so much pressure on the Federal Reserve, does it make their job harder? Because does it almost look political that they're now placating to the President of the United States, who is jawboning at Jay Powell whenever possible to lower interest rates?
They end up digging in. Look, we talked a lot about the so-called Trump put. The strike price was a whole lot lower than people thought it was only a few months ago. But the pressure comes from multiple places. Here's two. It comes from the polls and it comes from employment. If you start to see rising unemployment, you start to see it because of the policies announced in the last few months, That's the question. How much of that kind of pain are you willing to tolerate if one starts to infect the other? Employment starts to break down and it starts to hit the polls even more.
Which is the reason why it's interesting to look at each individual Congress member at town halls, at how they're responding to potentially pushing back against the president at a time when you've really seen him be the key whip, right, for a lot of congressional votes. It just raises this question about the breaking point at a time when it's not the stock market, maybe it's the bond market, but the bond market might not be in play if we're really truly pricing in weakness.
Caroline Levitt just said that the president is America's businessman in chief. Well, this is what the American people have to say. On Sunday, CNN poll says 39% of Americans approve of how Trump has steered the economy. And then when you look at the NBC poll, they talked about how unpopular, deeply unpopular the tariffs have been. 39% of respondents agree with the rollout. And you keep seeing this in the polls, and this is going to be a massive pushback on this White House and what they're trying to do.
Remember how bullish people were and why? They were bullish, this administration, because they believed they'd be pro-risk, pro-growth. Yes, you'd accept some tariffs, but the fuller platform would include some tax cuts. We've had to wait longer for that conversation to start than we thought it would only a few months ago.
And part of the problem with this is the sequencing of the tariffs first, which some people said was likely given the fact that that was something that the president could do unilaterally, has led to less agreement among Congress members to get through some of the tax cuts passed. And all of a sudden, there's a question of how much further they have to go with cutting taxes in order to offset maybe some of the drag that you've seen from the tariffs.
Stepping up to the podium, following comments from the Press Secretary Caroline Levitt, we can take a listen to some of the questions and some of the answers from the Treasury Secretary Scott Bessent speaking at the White House.
The administration